coin looks like money long before it actually becomes money. That may sound obvious, but hold one in your hand and the distinction suddenly becomes clear. It is a small piece of metal, perhaps dull with age, perhaps bright from polishing. It may carry a portrait, a coat of arms, a date, a number, or a Latin inscription. Yet none of those features alone gives it purchasing power. A lump of silver is not automatically a coin. A stamped disc is not automatically accepted at the baker's counter. Even a beautifully designed piece can be economically useless if nobody trusts it, recognizes it, or is obliged to take it. Money begins where metal, authority, and public confidence meet. The metal matters because a coin must be physically produced from something. The imprint matters because it identifies who issued the piece and often indicates its value. But above all, the coin needs recognized validity. It must be accepted in payment by custom, by confidence, or by law. That is what turns metal into usable money. A coin is, in a sense, an entrance ticket. Its material, its stamp, and its acknowledged legal standing allow it to enter the world of exchange. This is the first complication in the expression German coins. The phrase sounds as though it refers to the money of one clearly defined country. For long stretches of history, however, there was no single German currency in the modern sense. German coins is a collective term for coins, both circulation sizes and commemorative coins, that were minted by German mints or used as legal tender in German currency areas. The definition gathers together objects that might have belonged to very different political and monetary worlds. A coin struck in Berlin, Munich, Hamburg, Vienna, Frankfurt, or another mint could carry local authority rather than a common national identity. Its value might be expressed according to a regional standard. Its weight and silver content might differ from those of a coin circulating only a few dozen miles away. Merchants, travelers, soldiers, and officials had to navigate a landscape of overlapping currencies, competing coin standards, and changing agreements. Before 1871, there was no uniform or coherent German currency area. There was no single German state issuing one universally accepted national coinage from a central authority. Instead, the German-speaking lands were politically divided among kingdoms, grand duchies, duchies, principalities, free cities, and other territories. Each could have its own minting rights, its own traditions, and its own monetary arrangements. Even when states cooperated, cooperation did not erase difference. A treaty might establish a shared standard, but local designs and regional habits remained visible in everyday transactions. In such a world, the word mark did not initially point to a crisp gold coin or to the familiar decimal currency that would later shape the German economy. The name mark is derived from an old Germanic unit of weight. Before it became the name of a monetary unit, it belonged to the language of measurement. It referred to a quantity of precious metal, especially in contexts where silver or gold had to be weighed, assessed, divided, and recorded. That older meaning is crucial. A mark was not originally valuable because of a national government's promise printed onto a coin. It described an amount of metal. The word carried the authority of the scales before it carried the authority of the state. In a fragmented political landscape, weight could provide a common reference even when rulers, borders, and coin designs changed. The scale offered a language of comparison: how much silver was present, how much gold was owed, how many smaller units belonged to a larger accounting value. But weight alone could not create a unified currency. It could establish a standard, yet it could not by itself command acceptance from one end of the country to the other. For that, a political transformation was necessary, a decision that one monetary system should cross territorial boundaries and bind them together. The decisive leap came after German unification. On December 4, 1871, the first Reichsmünzgesetz introduced a unified imperial currency, the mark. It was divided into 100 pfennigs and established as a gold-backed currency. The old weight term was thus pulled into a new national framework. A word that had once measured precious metal became the name of a standardized unit issued by an empire. The journey from metal to money, from weight to currency, had begun. But how could a term born as a measure of weight become a common currency in a politically fragmented space? The answer leads back to the Carolingian coinage system, the framework from which the German coinage system ultimately developed. It was an attempt to impose order across a vast realm by giving silver a recognizable shape, a recognizable name, and a recognizable place in calculation. At its center stood the denar, or pfennig, a small coin, but one carrying an enormous burden. Originally, the Carolingian dinar was minted from silver. Its value rested not on decoration or abstract symbolism, but on the precious metal contained within it and on the authority of the system that defined its weight. The structure was simple enough to remember. A larger unit of account was divided into smaller ones, linking coins to sums that could be counted, recorded, and transferred. A merchant could price cloth, a farmer could settle a debt, and a ruler could collect a levy within the same monetary vocabulary. The pfennig was not merely something placed on a table. It was a bridge between scales, ledgers, markets, and obligations. That bridge, however, depended on continued political control. Coins had to be struck according to an accepted standard. Their silver content had to remain credible. The authority behind the mint had to reach beyond the mint itself, persuading people that a coin made in one place would be received in another. The Carolingian system could provide such coherence while its political order held together. Once that order weakened and broke apart, the pfennig remained, but the world surrounding it changed. Power moved outward. Local rulers, bishops, abbeys, towns, and territorial lords gained control over mints or asserted the right to issue money. The single framework fractured into overlapping jurisdictions. Coins acquired different weights, different silver contents, different marks, and different reputations. Some were heavier, some lighter. Some were fresh from the mint. Others had been worn thin by years of handling, clipped at the edges, or repeatedly exchanged. A pfennig from one territory might bear the same inherited name as a pfennig from another, while offering a different quantity of silver. This was the fragmentation of a currency system based on the silver pfennig, and it hindered trade and the wider economy. The difficulty was not simply that people encountered many designs. The deeper problem was that every transaction could require investigation. A trader arriving at a market did not necessarily ask only, "What does this cost?" He also had to ask, "Which pfennigs are being offered? What do they weigh? How much silver do they contain? At what rate will they be accepted?" Payment became an exercise in comparison. Coins might be sorted into piles, tested against a balance, examined for wear, or valued according to local custom. A sum written in one place could not always be handed over in the same form somewhere else. Debts stretched across borders at the speed of a cart or a riverboat, but the coins moving with them did not obey a single rule. The further a transaction traveled, the more room there was for disagreement, suspicion, and loss. the Middle Ages, Germany therefore had a wide variety of coins. That variety was not an amusing collection for a modern cabinet. It was an everyday commercial hazard. A peddler, innkeeper, toll collector, or wholesaler had to live with the fact that money changed character from one market to the next. Exchange specialists could profit from these differences, but ordinary traders paid for them through fees, unfavorable rates, and delays. Even when no one intended fraud, uncertainty itself acted like a charge added to every journey. The inherited name Pfennig promised continuity, while the coins themselves revealed division. The old silver standard still haunted the system, but its authority had been scattered among competing powers. A coin could be legal in one territory, discounted in another, and rejected farther away. What appeared to be a common language of payment had become a dialect chain, understandable in fragments, unreliable across distance. That tension explains why the history of the Pfennig is also a history of trust. People did not need every coin to look identical, but they needed dependable answers about weight, metal, origin, and acceptance. Without them, markets narrowed, long-distance exchange became more expensive. Contracts became harder to enforce. The small silver piece that had once helped bind a political order together now exposed the absence of one. The question was no longer how many pfennigs a mark contained. It was whether two people using the word pfennig meant the same thing at all. Who could guarantee that a pfennig would still be worth the same at the next market? No single answer could satisfy a traveler crossing the Holy Roman Empire at the beginning of the modern era. Authority over coinage belonged to an almost unmanageable multitude of electors, spiritual and secular, princes, dukes, counts, minor lords, and self-governing cities. Minting was not confined to a distant imperial center. It took place wherever privilege, custom, inheritance, purchase, or political leverage had placed the right to strike currency in particular hands. A border on a map could therefore become a border between monetary systems. One ruler might order a silver piece of a certain weight, while a neighbor issued a similarly named coin containing less precious metal. Another authority might retain the standard but alter the denomination, design, or rate at which foreign pieces were accepted. Images also carried claims. Portraits, coats of arms, saints, crosses, eagles, crowns, and civic emblems announced whose command stood behind the metal. Political fragmentation became something a person could hold in the palm. Such diversity did not mean that every mint acted without restraint. Reputation mattered, and rulers needed their issues to circulate. Established standards, commercial habits, and regional agreements imposed practical limits. Nevertheless, every minting authority possessed opportunities to shape weight, fineness, and appearance. In times of fiscal pressure, reducing silver or gold content could bring immediate revenue. A debased issue might resemble a trusted coin closely enough to pass before its weakness became widely known. Neighbors then faced a choice: reject it, discount it, imitate it, or revise their own currency in response. The resulting confusion extended far beyond small change. Gold pieces used in major transactions varied alongside the many silver denominations found in ordinary circulation. Names could travel more readily than standards, and appearance could suggest equivalence where none existed. Assessing a coin required knowledge: its place of origin, issuing authority, date, weight, metallic content, and current market reputation. Scales, touchstones, tables, and trained judgment formed an unofficial infrastructure beneath daily trade. A later investigation turned that bewildering landscape into numbers. On 27th May 1551, coin experts submitted a report listing 90 kinds of gold coin issued by 63 domestic authorities. They also identified 97 kinds of gold coin from 50 foreign authorities and 97 kinds of silver coin from 70 German authorities. The catalog thus covered 284 types across its 3 reported categories. Its arithmetic conveyed more than abundance. Traders within the empire had to reckon not only with numerous domestic issuers, but also with foreign gold entering commercial channels. Silver circulation added another dense layer of regional variation. Behind every type stood an institution defending income and status. The right to mint was economically useful because it could produce seigniorage, the difference between the value assigned to a coin and the cost of its metal and manufacture. It was politically valuable because striking currency made sovereignty visible. Surrendering control over a mint could mean losing revenue, prestige, and a tangible sign of jurisdiction. Reform consequently threatened interests that were deeply embedded in the imperial structure. Emperor Charles V made the first attempt to clean up this disorder across the empire. His ambition belonged to the wider history of the Reichsmünzordnungen, 16th century decisions of the Holy Roman Empire intended to regulate its coinage uniformly by law. A Reichsmünzordnung sought to replace a shifting field of standards with rules defining acceptable denominations, weights, and fineness. Uniformity promised easier valuation, more reliable commerce, and stronger confidence across territorial boundaries. Legislation, however, was only the beginning. Standards had to be accepted by estates jealous of their privileges, observed by mints with financial incentives to bend them, and enforced over a politically divided realm. Inspecting workshops, testing newly struck pieces, suppressing inferior issues, and controlling the rates assigned to outside currency demanded cooperation at many levels. Imperial commands could state what a proper coin ought to be. They could not automatically remove profitable alternatives from purses and marketplaces. Charles V, therefore, confronted more than a technical problem of weights and alloys. He faced the constitutional problem expressed through metal. Reform asked many authorities to treat a shared monetary order as more important than their separate advantages. Could an emperor enforce rules when so many lordships profited from their own minting rights? In 1524, the answer attempted at Esslingen was to give monetary diversity a common physical foundation. Its Reichsmünzordnung declared the Cologne mark the general coin weight for the German lands. By fixing an accepted unit from which prescribed quantities of coin could be struck, the ordinance sought to make issues from different mints measurable against the same standard. A denomination would no longer depend solely upon a local name or customary reputation. Officials could relate it to a shared measure of precious metal. The Cologne mark was a unit of weight, not a coin that passed from hand to hand. Adopting it, therefore, did not by itself determine the value of every piece in circulation. Coinage still required rules for fineness, denominations, and the number of pieces to be produced from a mark. Nonetheless, a common weight was indispensable. If mints calculated their output from different units, apparently identical requirements might yield materially different coins. Esslingen tried to establish a basis upon which a broader system could be built. On paper, the declaration looked like a decisive advance. In practice, it was scarcely implemented. Several of the larger imperial estates protested, and their resistance deprived the measure of the cooperation necessary to make it effective. These were not marginal actors whom the center could simply ignore. Major territories possessed administrative resources, established monetary customs, and interests tied to the operation of their mints. Accepting the ordinance could require them to alter familiar issues, revise valuations, or subordinate their own arrangements to an empire-wide scheme. The difficulty exposed the limits of command in a composite polity. A shared standard offered collective benefits, but the costs of transition fell unevenly. A territory whose currency already enjoyed favorable treatment had little reason to welcome a rule that might reduce its advantage. A minting authority might also resist external scrutiny of the relation between the nominal value of its coins and their metallic content. Agreement on the abstract desirability of order did not erase disputes over whose practice should change, who would bear losses, or who would supervise compliance. Failure at Esslingen did not end the search. It changed its form and demonstrated that a credible monetary settlement required detailed knowledge of the currency actually circulating. Ordinances could prescribe ideal pieces, while markets remained crowded with older domestic coins, recent territorial issues, and foreign money of uncertain quality. Any new system had to reckon with that inherited stock. Removing every non-conforming coin at once was unrealistic. Assigning it a reliable value demanded evidence. In April 1551, coin experts assembled at a valuation day in Nuremberg. Their task joined technical investigation to policy. They metallurgically tested circulating money, examining the precious metal content rather than trusting inscriptions, official claims, or conventional rates. Assay could reveal how much fine metal a piece contained beneath its stamped identity. Weight and fineness together allowed specialists to compare coins whose names and face values otherwise concealed substantial differences. The Nuremberg gathering was intended to do more than expose bad currency. On the basis of its tests, the experts were to propose rates for a planned new monetary system. Valuation was the bridge between existing disorder and projected regulation. Set a rate too high for an inferior piece, and holders would profit by passing it while better currency disappeared from circulation. Set it too low, and legitimate owners could suffer losses or refuse the official schedule. Rates, therefore, had to be technically defensible and politically tolerable. Here, monetary governance appeared as a process of measurement, negotiation, and repeated correction. The assayer's furnace and balance supplied information, but they could not decide how competing territorial claims should be reconciled. Metallurgical facts narrowed the range of plausible valuations. They did not compel every estate to accept the resulting arrangement. Expertise could tell lawmakers what coins contained. It could not guarantee that mints, governments, and markets would follow the same conclusions. Seen from Nuremberg, the 16th century Reichsmünzordnungen were thus repeated attempts to bring order to coinage rather than stages in a smooth, completed unification. Esslingen provided a general weight in 1524, but failed to secure broad implementation. The valuation work of 1551 showed that reform still required laborious examination of the monetary world as it existed. Every renewed initiative acknowledged the persistence of the problem, while every need for renewed initiative revealed the limits of the preceding solution. The result was neither simple defeat nor final success. Empire-wide legislation established reference points, created forums for expertise, and articulated the possibility of a more coherent currency. Yet the distance between a legal standard and daily acceptance remained wide. If imperial laws failed, could smaller alliances succeed where the emperor had failed? Smaller alliances could, at least within the range of commerce that bound their members together. Northern towns did not need to wait for a comprehensive settlement covering the whole realm. Their councils faced immediate problems. Unfamiliar pieces entered through ports and fairs, market prices depended on reliable comparisons, and citizens wanted assurance that currency received in one town would remain acceptable in the next. Urban governments therefore constructed a monetary order suited to the routes along which goods, credit, and people already moved. The clearest institutional expression of that approach was the Vendish Coinage Association, or Vendische Münzverein. It rested on agreements among cities seeking to align their currencies and recognize one another's issues. Rather than entrusting coordination to a distant central institution, participating councils negotiated shared terms and supported them through municipal practice. A peace accepted by partner towns gained a wider field of circulation. Reciprocal recognition reduced the friction of crossing jurisdictional boundaries. Urban cooperation did not abolish diversity, but it made diversity more manageable. Its strength came from the practical interests of the participants. A town benefited when its currency was trusted beyond its walls, while its partners benefited from receiving pieces whose treatment was already known. Mutual recognition turned confidence into a collective asset. If a member departed too far from expected quality or reckoning, it risked damaging both its own standing and the usefulness of the arrangement. Commercial interdependence thus supplied a form of discipline that broad legal commands often lacked. The cities had reasons to comply because the benefits appeared directly in their markets. Urban currency systems also reveal a gradual change in the meaning of the word mark. It had begun as the name of a quantity measured by weight. In trade and bookkeeping, however, a measured quantity could become a unit for expressing value even when no corresponding object changed hands. Account books could record obligations in marks, while actual settlement occurred through smaller denominations or through whatever acceptable pieces were available. Once familiar as a unit of account, the term could also attach itself to a particular currency and eventually to minted money. A word for mass thereby became a word for reckoning and then a monetary name. Regional adjectives recorded this process. They identified not merely places, but distinct conventions for counting and accepting value. From 1319, the Zundisch mark appears in Stralsund and Pomerania. Its use demonstrates that the mark was no longer only an abstract measure inherited from older weighing practices. It had acquired a regional monetary identity, intelligible within a specific commercial zone. Anyone dealing in Zundisch marks needed to know the convention attached to that designation, rather than assume that all marks represented an identical value. Further differentiation followed. From 1502, the current mark was used in northern Germany. Courant marked currency treated as current in ordinary circulation and distinguished its reckoning from alternative accounting systems. Its appearance did not erase older usages. It added another layer to a landscape in which the same basic monetary vocabulary could carry different numerical meanings according to place, date, and commercial context. Apparent linguistic sameness could therefore conceal substantial variation. Hamburg offers a particularly concrete illustration. Around 1550, one Silbermark was reckoned as 48 Witten, or later as 16 Schilling. The relationship linked a larger accounting unit to the denominations encountered in transactions. A merchant might state a price or keep a balance in Silbermarks while payment was counted in Witten. Subsequently, Schilling supplied the more familiar subdivision. The larger unit organized calculations even when daily circulation depended on smaller pieces. Monetary coherence could therefore exist as a stable arithmetic relationship rather than as a single dominant coin. None of these arrangements produced universal uniformity. Membership had boundaries, regional terminology remained plural, and values still required attention to context. Yet the northern cities achieved something important. They created zones of predictability through negotiated equivalence, repeated use, and reciprocal trust. Their monetary order followed commercial geography more closely than political geography. ports and inland markets were connected not because they belonged to one centralized fiscal system, but because their councils and merchants found coordination advantageous. Urban alliances, therefore, present a different path toward unity. Broad laws announced general ambitions. City networks built narrower conventions that participants immediate incentives to observe. Their success raises a larger question that extends beyond northern currency. Does monetary unity arise more effectively from below through trade than from above through the laws of the realm? Trade alone, however, could not eliminate uncertainty. Its conventions worked best among participants who repeatedly dealt with one another, recognized the same institutions, and trusted the same procedures. Hamburg's next step was therefore especially significant. The city did not merely coordinate the valuation of pieces passing from hand to hand. It developed a form of currency whose essential existence lay in written balances. The Markbanco was a book currency in Hamburg from the 17th through the 19th century. It should not be imagined as an ordinary coin with a fixed design that shoppers routinely carried in their purses. A balance in Markbanco existed primarily as an entry in the ledgers of the Hamburger Bank. Funds could be credited to one account and transferred to another without requiring the corresponding sum to circulate in a denomination bearing that name. The physical basis of finance had not disappeared. Deposits, specie, and precious metals still matter. Yet the unit used to record obligations acquired a life distinct from the assorted pieces available in the marketplace. That distinction made currency more abstract, but also potentially more dependable. Coins wore down, were clipped, differed in fineness, or arrived from mints operating under divergent rules. An accounting balance did not suffer physical abrasion. Its usefulness depended instead on institutional reliability, accurate ledgers, consistent conversion practices, credible administration, and confidence that entries would be honored. Trust shifted partly from the metallic object to the organization maintaining the books. For merchants, this offered a stable language of calculation amid a disorderly circulation. Prices, balances, loans, and settlements could be expressed in a dependable accounting value even when actual receipts included a mixture of specie. The important question was no longer solely what piece is being offered. It was also what value will the bank recognize and enter. Currency thus became divisible into two related layers: the tangible media presented for deposit or settlement, and the abstract measure through which business relationships were recorded. The Markbanco did not create modern immaterial finance in a single leap, nor did it abolish older denominations. Its importance lies in showing that a monetary unit could remain effective for centuries without being identical to a particular circulating object. Stability could reside in bookkeeping. A city whose prosperity depended on wide commercial connections had found a way to place arithmetic continuity above the changing condition and origin of individual coins. Territorial rulers pursued coordination by a different route. The Treaty of Zinna, or Zinna Münzvertrag, was signed in 1667. Associated above all with Brandenburg and electoral Saxony, it represented another attempt to align coinage rules across political borders. Rather than relying only on the habits of a merchant community, the agreement sought to establish a shared standard through negotiation among territorial authorities. The method recalled earlier cooperative arrangements, but its institutional center was princely government rather than an urban banking ledger. Zinna nevertheless remained a compact among particular participants, not a comprehensive solution for the whole Central European monetary space. A treaty could reduce friction within its area while leaving neighboring systems untouched. It could also be weakened when fiscal pressure, changing metal prices, or competing interests made adherence less attractive. Coordination expanded the zone of comparability, but the boundaries of that zone remained visible. Elsewhere, enduring currencies followed their own timelines. The Danish mark served as Denmark's currency unit from the 15th century until 1874. Its longevity demonstrates how older monetary frameworks could survive beside successive experiments in coordination farther south. Europe was not moving in a single rhythm from medieval variety toward national order. Book currencies, territorial agreements, inherited units, foreign pieces, and locally issued specie coexisted for generations. The same persistence characterized the lands that would become a unified German nation-state. Most German states continued to issue their own coins until 1871, and in some cases until 1873. Political unification, therefore, did not instantly erase the material products of former sovereignties. Old pieces remained in tills and pockets. Conversion required rules. Mints and administrations had to be reorganized. A national boundary could be proclaimed more quickly than a common currency could become an everyday reality. By the 19th century, the central problem was no longer a lack of workable models. Hamburg had shown how a reliable unit might live in books. Zinna had shown how rulers might coordinate standards by treaty. Denmark illustrated the resilience of a long-established unit, while the continued output of state mints exposed the depth of territorial autonomy. The missing element was an authority able to bind these approaches together, enforce conversion, and carry uniformity beyond a limited network. What power can finally transform regional treaties into a standard that reaches beyond individual trading places? An answer emerged in Prussia, where a centralized monarchy possessed both the administrative reach and the fiscal incentive to impose a carefully defined measure. Shortly before the middle of the 18th century, Frederick II recruited Johann Philipp Graumann, a mint master from Brunswick-Lüneburg. Graumann arrived not simply as a technician hired to supervise routine production. He was expected to redesign the basis on which Prussian pieces were struck and valued. Frederick's interest was practical. A ruler who maintained an army, collected taxes, paid officials, and purchased supplies required dependable calculations. Differences among circulating thalers complicated those calculations, while worn, clipped, or inconsistently valued pieces increased uncertainty. A clearly specified Prussian system promised greater control over state revenues and expenditures. It also offered a means of presenting the kingdom as an orderly economic power whose issues might be recognized outside its borders. Graumann was charged with replacing the existing arrangement derived from the Leipzig foot. Under that earlier standard, 12 thalers were reckoned from a fine Cologne mark of silver. The Cologne mark functioned here as a measure of precious metal content, not as a denomination passed from hand to hand. Defining a foot meant stating how many full thalers a mint could produce from that fixed quantity of fine metal. A higher number of thalers per mark consequently assigned less fine silver to each individual thaler. The proposed change was therefore concise in expression, but substantial in effect. 12 would become 14. In 1750, Prussian mints began striking 14 Reichsthaler from one fine Cologne mark of silver, according to Graumann's standard. Dividing the metal into 14 equal units gave each thaler 1/14 of the mark's fine silver content. Using the customary value of roughly 233.9 grams for the fine Cologne mark, this amounted to about 16.7 grams of fine silver per Reichsthaler. Alloy could increase a piece's total physical mass, but the prescribed quantity of pure silver remained the governing measure. The new ratio was meant to do more than lighten the thaler. Grauman sought a coherent structure whose denominations could be calculated from a stable central unit. With a known fine metal content, officials could plan mint output, compare receipts, and state obligations with fewer ambiguities. The Crown could also hope that a practicable standard would draw suitable bullion into Prussian mints, rather than drive it toward competing jurisdictions. Precision on paper did not eliminate the pressures of metal markets, yet it gave administrators a consistent point from which to respond to them. The arrangement soon took Graumann's name. It entered monetary history as the Graumannscher Münzfuß, written at times as Graumannscher Fuß. Since its defining rule produced 14 thalers from the fine mark, it was equally called the 14-Thaler Münzfuß, or, more briefly, the 14-Thaler Fuß. All of these labels referred to the same fundamental proportion adopted in 1750. Its significance lay partly in the clarity of that proportion. Earlier attempts at alignment had depended on agreements among multiple rulers, whose interests could diverge and whose enforcement capacities varied. Prussia's approach rested on a royal administration acting within its own dominions. Frederick could appoint personnel, direct mints, regulate acceptance by government offices, and connect the standard to taxation and military finance. The result was not universal agreement, but a more concentrated experiment in state-managed monetary order. Still, a decree and a mathematical ratio could not immediately make the contents of every purse uniform. Existing pieces continued to circulate, foreign thalers crossed frontiers, and users judged specie by familiarity as well as official tables. Prussian officials had to maintain the promised fineness if the new Reichsthaler was to acquire credibility. A standard that appeared exact but was applied irregularly would merely add another disputed piece to an already crowded field. Graumann's system therefore depended upon repeated assay, disciplined production, and consistent public acceptance. The reform nevertheless marked a shift in scale and ambition. The kingdom was no longer merely negotiating equivalences with nearby territories. It was asserting a standard designed to be internally coherent, fiscally useful, and potentially attractive beyond Prussia itself. 14 thalers from a fine Cologne mark formed a rule simple enough to remember and exact enough to administer. Whether that rule could become more than a Prussian solution remained uncertain. Would Prussia's precise standard become the seed of a German unified currency, or merely one more kind of thaler? In the immediate future, the answer was the latter. The Reichsthaler, based on the Graumann standard, did not displace its rivals. During the late phase of the Holy Roman Empire, it remained only one of 10 German varieties of thaler. The number itself reveals the limits of even a carefully administered initiative. A shared name did not imply a shared metallic content, and the word thaler could conceal consequential differences in weight, fineness, and legal value. Prussia had made its own unit more intelligible, but it had not acquired the power to define the unit for everyone else. Yet remaining one variety among 10 did not make the experiment insignificant. Its importance rested increasingly on duration. Prussian Reichsthalers continued to be minted until 1856, surviving the political world in which the standard had originated. Dynastic changes, wars, territorial rearrangements, and the dissolution of the Holy Roman Empire altered the map around them, while the Prussian monetary administration retained a recognizable line of practice. Such continuity mattered because a dependable unit was also an institutional habit. Mint officials accumulated experience, treasuries kept records in established denominations, and subjects learned what public offices would receive. Persistence could achieve what immediate imitation could not. A standard repeatedly maintained over decades became a stable point of reference in negotiations with neighboring governments. It supplied known procedures and a body of administrative knowledge that later reformers could adapt. The Prussian Reichsthaler thus occupied an intermediate position, neither a common German currency nor merely a brief royal experiment. It formed a durable northern core around which broader arrangements might eventually be attempted. The South, however, was not waiting passively for Prussia to furnish a solution. Bavaria and Austria signed the Bavarian-Austrian Coinage Convention in 1753. Their convention demonstrated that monetary cooperation could develop along a separate axis, shaped by Southern fiscal traditions and commercial connections. It also showed that the desire for alignment was widespread without being uniform. Governments might agree that fluctuating and incompatible monies imposed costs, yet disagree over which unit should anchor the remedy. This divergence gradually gave the monetary map a simpler outline than the earlier multitude of individual coin types suggested. The decisive distinction was becoming less one principality against another than one large accounting and circulation zone against a second. Across much of northern and central Germany, the Thaler served as the principal frame. In much of the south, the Gulden performed that role. Numerous subdivisions, exchange conventions, and local usages survived within both zones, but the larger contrast increasingly structured proposals for wider coordination. A Thaler state could not simply command a Gulden state to rename its accounts. Monetary units were embedded in tax schedules, salaries, rents, public debts, commercial ledgers, and ordinary expectations. Changing them meant revising far more than the designs struck on metal. It could redistribute gains and losses whenever old obligations were converted into new denominations. Officials therefore had reason to defend familiar units, even when they acknowledged the benefits of a broader settlement. The obstacle was no longer sheer disorder. It was the coexistence of two comparatively coherent traditions. There was one notable exception among the old German states. Before the monetary reform of 1871, Bremen stood apart from states otherwise using silver currencies denominated in thalers or gulden. Its exceptional position was linked to a system oriented toward gold rather than the prevailing silver bases. As a trading city, Bremen had developed requirements that did not fit neatly into the emerging binary geography. Its case was small in territorial terms, but instructive. No future settlement could assume that every participant began from precisely the same metallic foundation. Even so, Bremen did not overturn the main pattern. By the 19th century, the central problem was no longer how to reduce an apparently limitless catalog of pieces one by one. Long-lived standards and regional conventions had already produced larger blocks. That was progress, but it also concentrated the remaining disagreement. Choosing between them would carry political meaning. Acceptance of the Prussian unit might look like deference to Prussian leadership. Preservation of the Gulden could become a defense of Southern autonomy. Technical conversion and political balance could not be separated. The next stage would therefore require a device subtler than outright replacement. It would need to establish reliable equivalents while allowing governments, treasuries, and populations to retain familiar denominations, at least initially. How could the Thaler and Gulden states be connected without requiring either side to abandon its entire monetary system? A practical answer began to emerge within the Prussian-led German customs union. Beginning in 1831, the Graumannscher Münzfuß served as the basis for attempts to create a more uniform system among the participating states. Prussia's 14-thaler standard thus moved beyond its original territorial setting. It offered the customs union a ready-made point of reference, already in operation, administratively familiar, and capable of being extended without waiting for a wholly new unit to be invented. This development did not yet amount to a general settlement between North and South. It proceeded first among governments whose currencies were denominated in thalers. Their shared vocabulary made coordination less disruptive than a direct merger with the Gulden zone would have been. They could align the underlying standard while continuing to issue and calculate in forms familiar to their own officials and inhabitants. The process was therefore gradual, relying on a functioning model rather than on an immediate redesign of the entire landscape. In 1834, every state belonging to the German customs union that used a thaler currency adopted the Graumann 14-thaler coin standard. The timing was significant. Customs integration was creating more frequent economic contact, and incompatible monetary bases would have weakened the usefulness of reduced tariff barriers. A common standard among the thaler states could simplify comparisons and settlements inside the expanding commercial association, even though it did not eliminate every difference in circulation or administrative practice. Hanover also adopted the Graumann 14-thaler standard in 1834. Its participation showed that the standard's attraction was not confined strictly to the immediate institutional boundaries of Prussian leadership. A government could recognize the practical value of alignment without thereby accepting complete political subordination. That distinction mattered in a landscape where monetary choices were read as statements about influence and independence. The 14-thaler basis advanced because it could be presented as a usable convention, not merely as a badge of Prussian predominance. Yet this northern consolidation only sharpened the question left by the southern Gulden states. Greater coherence within one bloc did not itself produce coherence between the blocks. Indeed, once each side possessed a stronger internal structure, neither had much reason to discard its own denomination. The next step had to preserve both while making their relationship dependable. Southern governments had already moved toward coordination through the Munich Coinage Treaty of August 25, 1837. Their arrangement provided the counterpart needed for a wider compact. Negotiations no longer had to reconcile a multitude of isolated local systems individually. They could bring together two organized groups, the southern members associated through Munich and a collection of northern states connected through the customs union and the thaler standard. That bridge was formally erected on July 30, 1838, when the Dresden Coinage Treaty was signed. The treaty linked the members of the Munich Coinage Treaty with several northern German states under the German customs union. Dresden was therefore less an act of simple replacement than an exercise in joining structures that had already acquired their own internal consistency. It acknowledged the persistence of the thaler in the north and the Gulden in the south, while seeking to place both inside a larger framework. The location and form of the settlement expressed a careful balance. No single block was required at once to erase its accustomed unit, recall its entire circulation, or rewrite every domestic account. The parties instead accepted that cooperation could begin through agreed relations among systems. This approach reduced the symbolic cost of participation. A southern state could enter without proclaiming the defeat of the Gulden. A northern state could cooperate without loosening its connection to the 14-thaler basis. Dresden consequently marked a change in the scale of monetary diplomacy. The task was no longer limited to making neighboring issues tolerable or bringing closely related thaler states onto one footing. It now involved connecting two substantial regions whose currencies embodied different habits and political loyalties. Customs cooperation supplied the incentive, the northern standard supplied one anchor, and the Munich Compact supplied an organized southern partner. A signature, however, could establish obligations more readily than it could guarantee their daily operation. Traders and public treasuries needed more than a declaration of unity. Values had to correspond in calculations, coins had to remain intelligible across the dividing line, and the agreed relationship had to withstand actual payments rather than merely diplomatic wording. Could the Dresden Treaty turn political connection into a common currency area supported by reliable arithmetic? The treaty answered that question with a deliberately simple piece of arithmetic. Signed on 30th July 1838, it did not abolish either of the two principal units. It defined a Talergebiet and a Guldengebiet, named the governments belonging to each, and gave both regions an identical weight basis. The resulting structure was neither a uniform national currency nor a loose promise of reciprocal goodwill. It was a legally ordered relationship between two monetary worlds. The founding members of the Thaler area were Prussia, Saxony, Electoral Hesse, the Grand Duchy of Saxony, Saxe-Altenburg, Saxe-Coburg-Gotha, Schwarzburg-Rudolstadt for its Unterherrschaft, Schwarzburg-Sondershausen, and the elder and younger lines of Reuss. The Gulden area comprised Bavaria, Württemberg, Baden, the Grand Duchy of Hesse-Saxe-Meiningen, Nassau, Frankfurt, Saxe-Coburg-Gotha for the Principality of Coburg, and Schwarzburg-Rudolstadt for its Oberherrschaft. These qualifications mattered. Composite states and divided principalities did not always fit neatly into a northern or southern category. Different portions of the same polity might follow different monetary alignments. Beneath this territorial arrangement stood the Kölner Mark, defined as exactly 233.855 grams. Its function was fundamental. It supplied a common measure of metal from which the respective standards could be calculated. A Thaler and a Gulden did not need to bear the same name, denomination, or appearance if both could be traced to the same precisely stated weight. The treaty thereby converted coexistence into a numerical relationship that treasuries, mints, bankers, and traders could apply without renegotiating the value of the two systems in every transaction. The decisive ratio was expressed by the coin standard. 1 Kölner Mark corresponded to 14 Thalers, or 24.5 Gulden. Thus, a Thaler equaled 1 3/4 Gulden, or 1 Gulden and 45 Kreuzer. The ratio was fixed rather than left to customary estimation. Northern and southern bookkeeping could remain distinct, yet sums could be translated by a stable rule. This was the treaty's practical achievement. Unity appeared not as a single denomination, but as dependable convertibility. Its reach, however, was incomplete. Oldenburg later entered only for Birkenfeld, while its main territory remained outside. The various lines of Anhalt and Waldeck also joined subsequently on the Thaler side. Their accession demonstrated the attraction of a larger and more predictable monetary zone, but it did not turn the arrangement into a comprehensive German settlement. Expansion proceeded territory by territory, often following existing commercial orientation rather than any uniform map of sovereignty. A substantial outer ring persisted. Brunswick, Bremen, Hamburg, Hanover, Lübeck, both Mecklenburg countries, Schleswig, Holstein, Lauenburg, and Austria did not join, nor, as noted, did Oldenburg's principal territory. The absences included powerful governments, maritime trading cities, and lands tied to other monetary traditions. The treaty therefore established a broad core while leaving important routes and markets beyond its formal jurisdiction. A merchant could enjoy easier calculation over much of the interior and still encounter another standard on reaching a northern port or crossing into a non-member state. Formal membership and practical convergence were not identical. In 1848, the two Mecklenburg countries adopted the Graumann 14-Thaler standard, even though they had stayed outside the Dresden Compact. Their decision enlarged the geographical domain of the Thaler calculation without retroactively making them original parties. It also showed that a successful standard could spread through imitation. Governments might reject the obligations of a particular treaty while accepting the usefulness of its underlying monetary rule. The shared foundation itself was not permanent. In 1856, the basic unit used for the German coinage system changed from the Kölner Mark, commonly rounded in this context to 233.8 grams, though fixed in 1838 at 233.855 grams, to the 500-gram Zollpfund. The substitution placed monetary calculation on a larger and more convenient metric weight. It altered the language of the standard without abandoning the search for exact relations among participating currencies. Over less than 2 decades, the framework had thus passed through 3 stages: a treaty-bound ratio between Thaler and Gulden, widening adherence to the 14-Thaler basis, and a new common unit of weight. Each step made calculation more regular, but none by itself eliminated the plurality of denominations, territorial laws, and issuing authorities. Would a common basis of calculation be enough, or would Germany, after political unification, also need a single coinage law? Political unity supplied the occasion for a more decisive settlement. On the 4th of December 1871, only months after the founding of the new Reich, the Reichstag passed the first Reichsmünzgesetz, or Imperial Coinage Act. The measure gave the Federation a common legal foundation for a new standard and moved beyond the negotiated equivalences of the preceding decades. Rather than merely defining fixed relationships among several territorial currencies, the legislature selected a shared unit for the Kaiserreich, the mark. The choice tied the new unit to gold. In later usage, especially when it became necessary to distinguish the pre-war standard from depreciated paper issues, it was also called the gold mark. Its original name, however, was simply mark. The new unit represented both political consolidation and a practical monetary decision. A gold-based standard promised stable valuation in international trade, while a decimal structure offered a clearer framework than the inherited mixture of thalers, gulden, and smaller regional units. Implementation began without long delay. The first Prussian 20-mark gold pieces were struck in 1871 itself. They gave tangible form to a law that otherwise might have remained an abstract statement of value. A merchant, official, or saver could now see the new order embodied in a high-value piece bearing familiar sovereign imagery alongside its denomination within the Reich's standard. Further gold issues appeared at 10 mark and, subsequently, 5 mark, so that the Kaiserreich's gold series comprised denominations from 5 to 20 mark. These values did not serve identical purposes. The 20-mark piece concentrated substantial purchasing power in a compact form and was well suited to reserves, large transactions, and transfers between financial institutions. 10-mark pieces provided an intermediate value. The 5-mark gold coin extended the series downward, though its small physical size made it less convenient than larger pieces. Together, the 3 denominations made gold visible as the declared anchor of the system, even if ordinary purchases would rarely require such valuable metal. A unified standard did not mean that production was entrusted to a single national establishment. The federal structure remained plainly visible. Until 1918, every member state of the German Empire retained its right to mint coins. Kingdoms, grand duchies, duchies, Principalities and free cities could therefore continue issuing pieces through their authorized mints, provided those issues conformed to Reich law. The result combined legal uniformity with territorial variety. That arrangement produced a recognizable division between common value and particular identity. Weight, fineness, and denomination followed the shared rules, allowing a 20-mark piece from one state to be accepted on the same basis as a 20-mark piece from another. Yet the issuing state could identify itself through inscriptions, portraits, coats of arms, or other emblems. Prussian pieces naturally emphasized the Prussian monarch, while issues from other states displayed their own rulers or civic symbols. The coins thus presented unification not as the disappearance of the constituent states, but as their participation in a federally regulated order. This distinction was constitutionally significant. The Reich determined the unit and the technical requirements. The states preserved an inherited prerogative of issue. Their minting right no longer implied the freedom to create unrelated standards. It operated within a system whose values were valid throughout the Kaiserreich. Diversity survived on the surface of the pieces, while equivalence governed their monetary function. The mark remained associated with the German Empire from its introduction in 1871. Chronologies of the gold mark sometimes give its span as 1871, 1915–1938. 1915 reflects the final wartime phase of gold coin production and practical use, whereas 1938 marks the later formal withdrawal of the old imperial gold pieces as legal tender. Such differing endpoints distinguish the effective life of gold in circulation from the longer legal existence of the coins. Within the Kaiserreich itself, the decisive period extended from unification to 1918. Yet high-value gold pieces could not alone meet the needs of wages, food purchases, fares, taxes, and change at the counter. A standard had been chosen, and its most prestigious coins had begun to appear, but daily exchange required an ordered hierarchy of silver, base metal, and fractional denominations around that standard. How would a gold-backed unit of value become a complete system for everyday payments? The answer came through a more exact ordering of the denominations used below the principal gold pieces. On July 9, 1873, the Second Reichsmünzgesetz was passed. It supplied precise regulations for silver and small coins, extending the common standard into the routine transactions for which gold was unsuitable. The reform thereby acquired a practical structure. The mark would function not merely as a unit for larger sums, but also as the center of a graduated series of everyday values. Silver occupied the middle level of that series. Imperial silver coins were issued in denominations ranging from half a mark to 5 mark. They could serve for purchases and payments too large for loose copper or nickel pieces, but too modest to justify gold. Their relationship to the mark was explicit, so a holder no longer needed to calculate among unrelated regional systems. A half-mark piece, a 1-mark piece, and the larger silver values belonged to the same scale, regardless of where within the Reich they were received. These pieces differed in monetary character from full-value gold coins. Their face value did not depend simply upon the market worth of the silver they contain. They operated as subsidiary currency under statutory rules, with the Reich guaranteeing their stated place in the system. This allowed silver to remain useful without creating a competing standard whose value might fluctuate against gold. The law thus placed the metal in a subordinate but indispensable role. Below silver stood the pfennig. 100 pfennig formed 1 mark, and the available pfennig denominations extended from 1 to 50. This range provided change for the smallest retail purchases, while connecting those purchases directly to the national unit. Bread, postage, Short journeys, modest fees, and the balancing of a shopkeeper's account could now be expressed through divisions of the same mark used for rents, salaries, and larger obligations. The hierarchy was simple enough to be learned through use. Pfennig pieces covered the lower end, silver carried the intermediate values, and gold served the upper range. The materials and dimensions of the pieces helped users distinguish them, while their inscriptions identified their numerical relationship. What had once required familiarity with several standards could increasingly be handled as movement up or down a single decimal scale. The transition was not perfectly synchronized. In 1872, before the detailed legislation of the following year, Mecklenburg-Schwerin and Mecklenburg-Strelitz had already issued small coins that showed their relation to the mark. The two Mecklenburg states were the only German states to take this step at that time. Their initiative anticipated the direction of imperial policy. Even the humblest pieces were being recast as fractions of the new unit. Yet anticipation did not guarantee conformity. The Mecklenburg Pfennig issues of 1872 had been designed before the requirements of the Second Reichsmünzgesetz were settled. Once the law established the authorized specifications, those coins stood outside the definitive framework. Their values referred to the mark, but their technical and legal form did not comply with the regulations adopted in 1873. For several years, they nevertheless remained a visible remnant of the brief interval between the announcement of a common unit and the completion of its subsidiary currency. In 1878, the non-compliant Mecklenburg issues were withdrawn from circulation. Their removal was a minor administrative event, but it illustrated the discipline required by the new order. A shared name on a coin was not sufficient. Weight, metal, size, denomination, and legal status also had to correspond to the standards fixed for the Reich. By the end of this process, the mark had become tangible at nearly every level of ordinary exchange. Its authority appeared not only in prestigious gold pieces bearing rulers and emblems, but in silver handed over for a meal and in Pfennig counted out at a counter. Standardization reached daily life through these modest objects, repeatedly teaching the decimal relationship on which the currency rested. Within the Reich, the hierarchy was now largely complete. Yet Germany's political and commercial ambitions were not confined to its continental borders. Would the mark remain restricted to Reich territory as German rule expanded beyond Europe? Many currencies under one flag. Beyond the continental frontier, the answer was uneven. German sovereignty carried symbols, administrators, soldiers, and trading companies overseas, but it did not carry a single monetary system in an unaltered form. Colonial administrations confronted established habits of calculation, regional trade networks, shortages of specie, and economic ties that often pointed toward neighboring territories rather than toward Berlin. The result was a cluster of currencies connected by German rule, but distinguished by their denominations and practical settings. In German New Guinea, the monetary unit was the Neue Guinea mark. Its division into Pfennig preserved the decimal relationship familiar from the Reich, and the terminology clearly proclaimed its German affiliation. Yet the qualifying name mattered. This was not simply metropolitan cash transported unchanged across the sea. It was a colonial currency identified with a particular possession. German colonial pieces issued there bore denominations in Neue Guinea mark and Pfennig, translating the general idea of the mark into a geographically bounded form. The difference was more pronounced in German East Africa. There, the colonial series included the Pesa, the Rupee, and the Heller. These names reflected a monetary environment shaped by Indian Ocean commerce and by traditions that predated German occupation. The rupee occupied the principal place in this arrangement, while smaller transactions could be expressed through subordinate denominations. Its German character was conveyed not by replacing the regional unit with the metropolitan one, but through the design imposed upon it. The likeness of Wilhelm II appeared on the rupiah, joining a locally intelligible denomination to the ruler of the distant colonial power. That combination revealed the dual purpose of colonial money. It had to function among users accustomed to particular units, but it also served as a portable statement of sovereignty. A portrait, inscription, or emblem could claim possession without requiring the entire population to abandon familiar methods of reckoning. The pesa and heller likewise belong to this specifically East African structure. Together with the rupee, they formed an autonomous colonial hierarchy rather than a simple extension of the mark and pfennig sequence. German Southwest Africa followed another course. Its currency was the Deutsch Südwestafrika Mark. As in New Guinea, the word mark linked the territory to the Reich's monetary vocabulary, while the territorial designation separated the colonial unit from the metropolitan standard. The shared name might suggest uniformity, yet the existence of a distinct colonial mark showed that denomination alone did not erase administrative boundaries or different conditions of circulation. A colonial unit could imitate the language of the Reich while remaining attached to its own jurisdiction. Kiautschou, the least territory on the coast of China, departed still further from metropolitan terminology. The German colonial piece issued there was denominated in cent. That choice suited a port situated within dense Chinese and international networks of trade. A coin labeled cent did not resemble the hierarchy of mark and pfennig, nor the East African sequence of rupiah, pesa, and heller. It nonetheless operated beneath the same imperial flag. German power expressed itself there through a denomination adapted to the monetary surroundings of the leasehold. No single path therefore connected overseas possession with monetary assimilation. New Guinea employed the Neuguinea mark and pfennig. Southwest Africa had the Deutsch Südwestafrika Mark. East Africa used pesa, rupiah, and heller. Kiautschou issued the cent. Some colonial systems retained the mark name, some incorporated German subsidiary terminology, and others relied on units rooted in broader regional practice. Wilhelm Two-Foot Portrait could make a rupee unmistakably imperial, even though its name was not derived from the Reich's principal unit. This variety was not merely decorative. It disclosed the limits of standardization. Within continental Germany, monetary unification had required exact rules governing value, material, and legal status. Overseas, rule operated through adaptation as much as through replication. The colonial state could attach its insignia to several monetary languages and accept that subjects under one flag did not necessarily count, price, or pay in the same units. Such flexibility remained manageable while confidence in convertibility, public credit, and metallic reserves endured. The deeper test would arrive not at a remote colonial counter, but at the financial center of the Reich itself. What would happen to the gold-backed order when a European war compelled the state and the banks to finance without limit? The answer came on 4th August 1914, when Chancellor Theobald von Bethmann-Hollweg's government suspended the Reichsbank's legal obligation to redeem its banknotes in gold. The decision was presented as a wartime necessity. Mobilization demanded immediate expenditure, while depositors and note holders might otherwise drain the Reichsbank's reserves by seeking metal. Yet the suspension did more than protect a stock of bullion. It severed the practical bond that had supported the monetary order of the Reich. A banknote continued to bear its stated value, but its holder could no longer compel the issuing institution to provide the corresponding quantity of gold. On the same day, the exchange of gold coins for other forms of money ceased. Reichskassenscheine and Reichsbanknoten were issued to meet the sudden demand for means of payment. Gold pieces increasingly disappeared from ordinary circulation as households retained them and the state sought to preserve its reserves. The outward vocabulary of the pre-war system survived. Prices, wages, taxes, and liabilities were still expressed in mark. What changed was the foundation beneath those figures. Convertibility had become a promise deferred until an uncertain peace. A further instrument widened the supply. The state introduced Darlehenskassenscheine, notes issued through wartime loan offices and circulating beside Reichsmark banknotes. They formed parallel money within the same national economy. Their appearance allowed assets and goods to support additional lending without requiring an equivalent increase in precious metal reserve. To a person receiving one in payment, a Darlehenskassenschein could resemble a practical substitute for the familiar paper mark. Institutionally, however, it testified to the exceptional machinery created for war finance. These measures were initially framed as temporary. That description helped preserve confidence, for it implied that victory and peace would restore the suspended order. The scale and duration of the conflict steadily weakened that assumption. Military operations consumed resources far faster than ordinary revenue could replace them. Rather than cover the full burden through immediate taxation, the Reich relied heavily on borrowing, transferring much of the cost into the future. Between September 1914 and September 1918, Germany issued 9 war bonds. Subscription campaigns invited citizens, firms, and institutions to lend their savings to the Reich. Publicity joined financial calculation to patriotic obligation. Purchasing a bond became a civilian contribution to the national struggle. The borrowed sums returned to circulation when the government paid soldiers, suppliers, transport providers, and armaments producers. Subscribers exchanged liquid resources for claims upon the state, while the state acquired the capacity to spend at once. The mechanism depended upon expectations that the war would end favorably and that the post-war Reich could honor its obligations from future revenues. Repeated bond drives concealed the growing imbalance without removing it. A loan did not pay for the war in any final sense. It postponed the moment at which the population would bear the cost. As the conflict continued, paper claims multiplied while civilian goods became scarcer. Official prices and controls could restrain visible increases in some areas, but they could not restore the lost relationship between the volume of claims and the resources available for purchase. By 1918, the consequences could no longer be treated as a short interruption. The mark had officially lost more than half of both its purchasing power and its exchange rate. Its reduced domestic value reflected the rising cost of obtaining goods. Its decline abroad reflected diminished confidence in the financial position and prospects of the Reich. These were two aspects of the same wartime transformation. The unit retained its name, but what that unit could command had contracted sharply. The fiscal inheritance was equally severe. In November 1918, as defeat and revolution ended the imperial regime, the national debt stood at approximately 150 billion mark. That total exceeded the entire German national income of 1919, estimated at 142 billion mark. The comparison revealed a burden that could not be resolved by a simple return to peacetime administration. The state emerged from war responsible for an immense volume of obligations, while production, political stability, and confidence had all been damaged. The measures of August 1914 had therefore opened a breach that the armistice did not close. Suspension, parallel notes, repeated borrowing, and falling value left the successor government with claims far greater than its immediate capacity to satisfy them. Yet depreciation was not inevitably the same as total collapse. How, after 1918, would this wartime devaluation become a currency catastrophe of historic proportions? The answer lay in the way the post-war state inherited and extended the wartime financial system. The notes that had served the German Empire during the conflict did not disappear with the armistice. The papier-mark became the working currency of the inflation years from 1914 to 1923, carrying into peace the obligations created under emergency conditions. Its continued circulation gave the authorities a convenient instrument. Expenditure could be met immediately, while the consequences were displaced into prices, exchange rates, and the savings of those who held the currency. The arithmetic of the new republic was harsh. Tax receipts lagged behind expenditure, political unrest disrupted production, and the state faced both domestic liabilities and demands arising from the settlement imposed after the war. The expectation that future payments from defeated opponents would cover the cost of victory had not survived the outcome. In August 1915, State Minister Karl Helfferich had argued in the Reichstag for financing the war through reparations paid by Germany's opponents. That proposal rested on a calculation that the burden could later be transferred outward. Instead, the Reich emerged with debts of its own, while post-war claims and reparations pressed upon its reduced economic capacity. Borrowing, therefore, remained politically easier than taxation or immediate retrenchment. Each additional issue of notes could postpone an open confrontation with creditors, employees, pensioners, and local authorities. Yet postponement altered the scale of the liability. As prices rose, contracts were revised more frequently, merchants shortened credit periods, and households attempted to exchange notes for goods as quickly as possible. The currency ceased to function reliably as a store of value. Even when individual payments were made on time, the meaning of the payment could change radically between agreement and settlement. The process accelerated after 1921 and became extreme in 1923. Reparations disputes, the occupation of the Ruhr, passive resistance, production losses, and the cost of supporting workers who refused cooperation with the occupying authorities all increased the demand for public funds. More notes entered circulation while fewer goods were available for purchase. The result was not merely a general rise in prices, but a transformation in daily calculation. Wages were paid at shorter intervals, denominations became obsolete almost as soon as they were printed, and sums that had once represented substantial assets lost practical significance. The German inflation from 1914 to November 1923 became one of the most radical currency devaluations experienced by a major industrialized nation. Its severity was measured not only by the fall in the external value of the mark, but also by the destruction of domestic balances. Savings accumulated over decades could no longer provide security. Fixed incomes were especially exposed, whereas borrowers and holders of tangible goods might escape part of the damage. The social consequences were therefore uneven, and the memory of the collapse extended beyond the immediate loss of purchasing power. France interpreted the deterioration through the lens of the reparations conflict. Between 1919 and 1923, it accused the German Reich of intentionally provoking the ruin of its own currency in order to demonstrate an inability to pay the reparations required by the Versailles Treaty. The accusation reflected genuine suspicion, but the situation also contained forces that were not reducible to a single plan: wartime debt, political resistance to taxation, disrupted output, reparations pressure, and the costs of emergency support reinforced one another. Whether the collapse was engineered or allowed to proceed, its effect was clear. The currency no longer offered a credible measure for long-term exchange. Stabilization required a break with the arithmetic of the papier mark. On November 15, 1923, 1 trillion papiermark, 1 trillion, was converted into 1 Rentenmark. The ratio was so large that it expressed the catastrophe more clearly than any ordinary percentage could. It did not restore the wealth erased during the inflation, nor did it settle every fiscal dispute. It established instead a new unit and a new promise that issuance would be constrained by assets and institutional discipline. The Rentenmark was used from 1923 into 1924, with its legal presence enduring in German monetary practice until 1948. Its introduction brought a measure of stability because people could again compare prices across days and weeks without expecting immediate collapse. Trust, however, was not created by a conversion table alone. It depended on restraint, enforceable arrangements, and the belief that public authorities would not repeat the methods that had destroyed the previous unit. The question remained whether stabilization could produce a permanently credible currency and what would remain of it after the next war. The answer proved less permanent than the institutions of stabilization had anticipated. In 1924, the Reichsmark followed the Rentenmark and served as the currency of the German Reich until 1948. It survived the collapse of the Weimar Republic, National Socialist rule, a Second World War, and the destruction of the state that had issued it. After 1945, however, survival in circulation did not mean that it still performed its functions reliably. Goods were scarce, prices were controlled, and much trade moved outside official channels. Cigarettes, food, and other useful objects could carry greater practical weight than notes whose purchasing power was increasingly uncertain. The occupation of Germany placed this monetary disorder within a larger political question. A reform might restore ordinary trade, improve tax collection, and give wages a more dependable meaning. Yet any decision about who issued the new money and where it circulated would also help determine the future structure of the occupied country. A common currency could support common administration. Separate currencies could turn occupation zones into distinct economic territories. In February 1948, the United States and Great Britain proposed in the Allied Control Council that a new currency be introduced for all of Germany. The proposal preserved, at least formally, the possibility of a single monetary settlement under the four occupying powers. Agreement would have required decisions about issuance, control, distribution, and the relation of the new notes to the economic systems emerging in the Western and Soviet zones. Those decisions were inseparable from the widening conflict among the Allies. The Council did not provide a workable common solution. Preparations in the Western zones had already advanced. On July 23, 1947, the Sonderstelle Geld und Kredit was created in Bad Homburg vor der Höhe. Led by Ludwig Erhard, it prepared the reform from the West German side. Its work addressed more than the appearance of new notes. A replacement had to set rules for old balances, public obligations, wages, prices, and the quantity of money that could enter circulation. The technical details would decide who retained claims, who suffered losses, and whether the new unit would command confidence. An issuing structure was also taking shape. On March 1, 1948, the Bank Deutscher Länder was established as the central bank of the state central banks. Its federal form reflected the political organization developing in the Western occupation zones, while providing an institution able to coordinate monetary policy above the individual Länder. Even before a West German state existed, an important part of its future financial order was therefore being assembled. A parallel institutional development occurred under Soviet administration. On May 28, 1948, the Soviet military administration in Germany announced the establishment of the Deutsche Notenbank. The announcement made the approaching monetary division visible. There would not merely be different administrative methods within one system. Rival institutions were now positioned to issue and govern money in different parts of the country. The Western decision followed within weeks. On June 20th, 1948, the currency reform took effect in the Tri-Zone, the combined American, British, and French occupation zones. The change was intended to remove the monetary overhang that burdened the official economy and to create a unit suitable for regular production, wages, saving, and exchange. It also drew a clearer boundary around the Western economic area. A measure presented as necessary for recovery had constitutional and geopolitical consequences, even though no new Western constitution had yet entered into force. On June 21st, the Deutschmark became the sole legal tender in the Tri-Zone. The Reichsmark's period of use, extending from 1924 to 1948, had ended there. The transition did not simply replace the name printed on banknotes. It transferred monetary authority to institutions created in the Western zones and tied everyday economic life more closely to their developing political framework. Money now registered the separation that diplomacy had failed to prevent. Prices, accounts, wages, savings, and public budgets would henceforth be organized through different issuing authorities. The line between occupation zones was becoming a line between monetary systems, and that line would affect recovery, trade, and political allegiance. How would the Deutsche Mark and the East German currency now shape the economic and political division of Germany? To understand the depth of that division, it is necessary to look back at the monetary disorder concealed beneath the Reichsmark's formal survival. Long before the occupation authorities abolished it, the unit had ceased to perform several of money's basic functions. In 1943, the Reichsmark lost its convertibility on the international foreign exchange market because it had become effectively worthless abroad. Wartime controls could preserve official quotations, prohibit unwanted transactions, and compel its domestic use, but they could not restore outside confidence. The collapse of the Nazi state made this weakness unmistakable. Reichsmark notes remained in wallets, cash registers, and payroll offices, yet possession of them did not guarantee access to food, fuel, clothing, or shelter. Rationing and price regulations continued, while shortages narrowed the range of items obtainable at official prices. Those who had merchandise often preferred to keep it, barter it, or sell it clandestinely. The nominal quantity of money thus bore little relation to the supply available through legal channels. Into this already swollen circulation came a second occupation currency. Beginning in 1944, the Allies issued Allied military currency, commonly called the military mark, for use by their forces and occupation agencies. It circulated beside the Reichsmark in Germany and remained in use until 1948. The notes were intended to provide a practical means of payment without immediately determining the country's permanent monetary future. In practice, they added another layer to a system already burdened by excess purchasing power. For civilians, the distinction between the two kinds of paper was less important than the question of what either could buy. Military marks could settle certain official payments, but they did not fill shops or repair supply networks. Nor did their introduction remove the accumulated Reichsmark balances created through wartime finance. More notes now competed for scarce output. Legal prices became increasingly detached from the terms on which actual transactions occurred. The handling of military currency also exposed tensions among the occupying powers. Red Army soldiers were not permitted to exchange their Allied military currency into rubles. The notes they received, therefore, could not simply be taken home and converted into Soviet money. They had to be spent, transferred, or otherwise disposed of within the occupied monetary sphere. This rule encouraged military marks to move through informal channels and ultimately into redemption arrangements involving the Western issuers. The consequences were expensive. The Western authorities had undertaken to honor Allied military notes presented for redemption, although they did not exercise equal control over the quantity entering circulation in every zone. As notes flowed toward institutions obliged to accept them, the liability accumulated far from the places where much of the currency had first been paid out. The United States Treasury eventually suffered a total loss of $530 million through the redemption of Allied military currency. That loss was more than an accounting anomaly. It demonstrated that occupation money depended on shared discipline among powers whose interests were rapidly diverging. A note could appear uniform while the policies governing its issue, use, and return were not. The military mark provided temporary convenience, but it could not create a coherent monetary area where no common political and fiscal policy existed. Daily behavior revealed the same failure from below. Black markets supplied goods unavailable through regulated shops. Cigarettes, foodstuffs, coal, clothing, and household objects became informal measures of value. Barter connected farmers, urban residents, soldiers, refugees, and intermediaries in transactions that official statistics could scarcely capture. A worker might receive wages in Reichsmarks and then seek necessities through an exchange in which those wages played almost no role. Savings survived numerically while losing practical meaning. Both currencies consequently rested on command more than confidence. The Reichsmark retained legal status despite its foreign worthlessness and shrinking domestic usefulness. The military mark carried the backing of victorious armies, but remained entangled in incompatible occupation policies and costly redemption obligations. Neither offered a stable foundation for reconstruction. Yet replacing them openly threatened to sharpen political conflict, provoke speculation, and trigger a flight into the remaining goods. Any workable reform required new notes, secure printing, distribution plans, conversion rules, and institutions capable of limiting the future supply. It also required secrecy until the moment of exchange. How, under these chaotic conditions, did the Western Allies secretly prepare a new currency? The answer developed in documents, printing plants, shipping schedules, and guarded depots, rather than in public declarations. Long before residents of the Western occupation zones were told that their money would be replaced, specialists had begun designing the legal and material machinery of reform. Secrecy was not incidental. Advance warning would have encouraged holders of Reichsmarks to convert them into food, fuel, equipment, and other tangible assets, worsening shortages and undermining the exchange before it began. A principal intellectual foundation had already been prepared in 1946. The Kolm-Dodge-Goldsmith Plan, named for economists Gerhard Kolm, Joseph Dodge, and Raymond Goldsmith, addressed the accumulated financial burden left by dictatorship and war. Monetary replacement alone would be insufficient. The volume of claims denominated in old money had to be reduced, public finances placed on a more credible footing, and rules created for converting wages, prices, savings, and liabilities. Reform also had to prevent the same excess of money from quickly reappearing. Not every proposal in the plan became law in its original form. Nonetheless, the currency laws eventually drafted for the Tri-Zone drew largely upon the Kolm-Dodge-Goldsmith framework. Its importance lay less in a single conversion formula than in its treatment of reform as a coordinated operation. The old monetary overhang, the opening supply of new notes, the status of financial claims, and the discipline imposed after conversion belonged to one process. This framework enabled Western officials to move from general recognition of monetary collapse toward legislation that could be implemented rapidly. Material preparations advanced while political discussions remained unresolved. Starting in September 1947, notes intended to become the Deutschmark of the Tri-Zone were printed in the United States by two producers, the American Banknote Company and the Federal Bureau of Engraving and Printing. Thus, the physical currency existed before the final political order authorizing its introduction. Printing on such a scale required decisions about denominations, numbering, paper, design, packaging, and quantities. It also demanded strict compartmentalization. Too much knowledge among printers, transport workers, occupation personnel, or officials in the zones could produce rumors, counterfeiting attempts, or premature economic reactions. The notes then had to cross the Atlantic and reach secure locations close enough for a sudden issue. That movement took place under the code name Operation Bird Dog. From February through April 1948, approximately 5.7 billion Deutschmarks were secretly transported to Germany. The consignments represented more than printed paper. They were the physical precondition for replacing the old currency within a narrow interval, before information and speculative behavior could outrun the occupation authorities. Transport was only one part of the problem. The notes had to remain protected and unobserved after arrival, then be divided for regional distribution without revealing their purpose too early. Officials needed counts of the population, arrangements for businesses and public offices, instructions for financial institutions, and procedures governing initial allocations. Conversion rules had to distinguish immediate purchasing needs from the much larger nominal holdings accumulated in old accounts. If too little new money entered circulation, ordinary trade could seize up. If too much appeared at once, the reform would reproduce the inflationary imbalance it was intended to end. Meanwhile, negotiations among the occupying powers yielded no common German solution. The growing divergence between the Soviet zone and the Western zones made delay increasingly costly. A unified reform remained desirable in principle because monetary areas did not fit comfortably within occupation boundaries. Yet a common policy would also require agreement over economic administration, financial controls, and the political future of the country. Those conditions were disappearing. On June 1, 1948, the Western Allies made the final decision to proceed with currency reform in the Tri-Zone rather than wait for an all-German settlement. By then, preparation had overtaken negotiation. The conceptual basis dated back 2 years. The notes had been coming off presses since the previous September, and billions in new currency had already reached Germany under Operation Bird Dog. What remained was to enact the laws, announce the conversion, and place the notes in civilian hands. The decision promised a functioning monetary area in the West, but its geographical consequences could not be concealed. The Western occupation zones could be treated as a connected economic territory. Berlin, divided among 4 powers and situated inside the Soviet zone, could not. Introducing the new, money there risked turning an administrative measure into an open test of occupation rights and political resolve. How could the new currency be issued without making Berlin the immediate focal point of conflict with the Soviet Union? On June 18, 1948, the military governors of the Western occupation zones assured Marshal Vasily Sokolovsky that their impending reform would not be extended to the western sectors of Berlin. The promise drew a geographical boundary around the operation. The new money would circulate in the three western zones, while the four-power city would remain outside it. In theory, this distinction prevented a monetary measure from altering Berlin's status. In practice, it exposed how difficult that status had become to preserve. Berlin's economy was inseparable from the surrounding Soviet zone and simultaneously tied to the Western powers responsible for its American, British, and French sectors. Wages, food supplies, transport links, bank balances, and commercial payments crossed sector boundaries. If the city retained the old money while the Western zones abandoned it, Berlin might become a refuge for unwanted Reichsmarks. If separate reforms reached its different sectors, monetary division would appear inside the city itself. The assurance to Sokolovsky therefore postponed the decisive confrontation without removing its cause. 2 days later, on Sunday, June 20th, the reform began in the Western zones. Its first tangible act was deliberately modest. Every resident received an initial allowance of 40 Deutschmarks. This head money placed usable cash directly into civilian hands and gave everyone, at least for the moment, the same starting sum. Distribution points opened, queues formed, identities were checked, and bundles of unfamiliar notes emerged from the stockpiles prepared in secrecy. The amount was enough for immediate purchases, not enough to release a flood of demand. The new notes mattered because scarcity gave them credibility. Under the old monetary order, enormous cash holdings had chased a limited supply of goods. Prices fixed by regulation had ceased to describe what objects were actually worth, while barter and unofficial trade filled the gap. 40 marks per person could not by itself repair production or distribution. It could, however, begin to restore a connection between the money in a wallet and the goods offered for sale. The old Reichsmark and Rentenmark were not simply renamed and accepted at equal value. They had to be exchanged, and their nominal value was reduced in the process. Treatment varied according to the kind of holding or obligation involved. But the governing purpose was clear. The accumulated monetary overhang could not be carried intact into the new system. A person who possessed a large sum in old notes did not automatically receive the same numerical sum in Deutschmarks. The reform thus separated immediate subsistence from past balances. The 40-mark allowance supplied cash for everyday life, whereas the conversion rules subjected inherited claims to substantial reduction. This distinction also gave the change its harsh edge. Those whose wealth consisted mainly of cash or bank deposits saw nominal figures contract. Others possessed goods, buildings, equipment, or inventories whose practical value survived more readily. Monetary stabilization promised broader benefits, yet its first accounting was unavoidably unequal. A clean beginning for the currency did not mean a clean or equal beginning for every household. The distribution was intentionally staggered. 1 month after the first payment, each person received a second installment of 20 Deutschmarks. The total head allowance therefore reached 60 marks, but it did not enter circulation all at once. The interval allowed officials to observe the response of shops, consumers, employers, and banks while keeping the quantity of new cash under control. It also reinforced the message that the new notes were finite. Money would again have to be earned, spent selectively, deposited and trusted rather than discarded at the earliest opportunity. That credibility had a political cost. A functioning Western monetary area made the economic separation of occupied Germany more concrete. The reform was presented as an urgent answer to paralysis, yet it also equipped the Western zones with one of the basic institutions around which a distinct state could later be organized. The more usable the new currency became, the harder it was to portray the Western economic territory as merely provisional. Berlin concentrated this contradiction. The June 18th assurance demonstrated that the Western governors understood the danger, but the events of June 20th increased it. Once the surrounding monetary map changed, Leaving the western sectors untouched could not preserve normality. It could only create a vulnerable monetary island. Extending the reform there would challenge the Soviet interpretation of the city's place within its zone. Withholding it would separate Western Berliners from the economy being reconstructed under Western supervision. 60 marks offered millions of people a carefully rationed beginning, while the unresolved status of Berlin threatened to turn that beginning into a contest of power. Could the new Deutschmark develop from an instrument of the occupying powers into the stable currency of a West German state? The answer emerged quickly. On June 20th, 1948, the Deutschmark replaced the Reichsmark in the American, British, and French occupation zones. It also reached the three western sectors of Berlin, where monetary reform could not be separated from the struggle over the city's future. What had begun as an administrative remedy for economic paralysis thus acquired a territorial meaning. The notes circulating in Western-controlled areas identified an economy that was increasingly being governed apart from the Soviet zone. This monetary geography did not include every territory later associated with West Germany in the same way. The Saarland followed a separate course under strong French influence. In 1947, it briefly used the Saar mark, an interim currency introduced before the territory was more closely connected to the French monetary system. Its existence was short but revealing. No single settlement automatically followed from the collapse of the Reichsmark. Occupation policy, borders, and competing plans for reconstruction could produce different currencies even among neighboring German-speaking territories. In the American and British zones, economic coordination had already created the bi-zone. The inclusion of the French zone produced the tri-zone, in which the Deutschmark was used from 1948-49 onward. The currency therefore preceded the state with which it would become most closely identified. When the Federal Republic of Germany was founded in 1949, it inherited an operating monetary area, a functioning means of payment, and institutions already accustomed to managing the new unit. The DM remained the Federal Republic's legal currency until 2001. Although the euro existed for accounting and electronic purposes from 1999, Deutschmark notes and coins continued to structure ordinary cash payments through the end of 2001. The currency's political significance lay partly in this continuity. Constitutions, governments, and borders might still appear unsettled in the late 1940s, but wages, prices, savings, taxes, and commercial obligations were increasingly expressed in Deutschmarks. Repeated use made the currency familiar. Familiarity encouraged confidence, while confidence made it easier for businesses and households to plan beyond immediate survival. The DM gradually ceased to look like a temporary occupation instrument and became a durable feature of West German public life. Responsibility for issuance likewise moved from a transitional framework into a permanent federal institution. In 1948, the Deutsche Mark was issued by the Bank Deutsche Länder. This organization connected the central banks of the Western states and supplied a monetary authority before the Federal Republic itself existed. Its position reflected the circumstances of occupation. Economic unification had advanced far enough to require coordinated money, even though political unification under a new West German state had not yet been completed. In 1957, the newly founded Deutsche Bundesbank assumed responsibility for issuing the DM. The transfer was more than a change of name or administrative location. The Bundesbank was designed to exercise substantial independence from day-to-day political direction. That independence became a core principle of West German stability policy. Monetary decisions were not supposed to serve the immediate financing needs of a cabinet or parliamentary majority. The memory of currency destruction made insulation from political pressure appear not merely technical, but constitutional in spirit, even when the relevant safeguards were defined by statute and institutional practice. This arrangement did not eliminate political choices. Decisions about interest rates, credit conditions, liquidity, and the defense of the currency affected employment, investment, public budgets, and exports. Nor did independence mean an absence of disagreement between the central bank and elected governments. It meant that such disagreements were built into the system rather than resolved automatically in favor of the government of the day. The resulting tension was treated as a safeguard. Stable money required an institution able to refuse demands that threatened its value. Over the following decades, the DM became associated with Reconstruction, expanding production, and the Federal Republic's integration into Western market. Its reputation often made monetary stability appear natural, although it rested on restrictive choices, institutional discipline, and favorable economic conditions. By remaining in use from the Trizone through the entire life of the pre-Euro Federal Republic, the Deutsche Mark helped give West German statehood an everyday material form. Yet monetary division necessarily had another side. What counter-currency arose in the Soviet occupation zone, and how did it change over the course of East German history? The answer appeared almost immediately. On 23 June 1948, the Soviet occupation zone carried out its own currency reform. Reichsmark holdings were exchanged at a ratio of 10-1, replacing the discredited money with a separate Eastern currency. The speed of the response reflected the rapidly hardening division of Germany. A measure intended to restore monetary circulation also defined the boundaries within which each occupation authority could exercise economic power. The reform did not yet present the Eastern Zone as a permanently separate country. Its new currency was likewise called the Deutschmark. It served as the currency of the Soviet occupation zone from 1948 to 1949, and, following the creation of the German Democratic Republic, remained in use there from 1949 to 1963. The shared name suggested that the claim to represent Germany had not been abandoned. East and West now possessed distinct monetary systems, yet each could attach the word German to its own mark and thereby deny that the other state held an exclusive right to national continuity. For residents of the Eastern Zone, the 10-1 exchange was a direct intervention in household balances and savings. Nominal sums accumulated in Reichsmarks were sharply reduced as the new unit became the basis for wages, prices, deposits, and payments. The reform drew a practical monetary frontier through a country that still contained many personal and economic connections between its zones. Money issued under one political order could no longer circulate on equal terms under the other. The division was encountered not only in official declarations, but whenever someone was paid, purchased necessities, or counted what remained in an account. The name Deutschmark nevertheless created an ambiguity. It invoked a common national identity while denoting a currency controlled by Eastern institutions and embedded in the German Democratic Republic's planned economy. The same words could therefore indicate rival political projects. In the West, the abbreviation DM became closely connected with the Federal Republic. In the East, continued use of Deutschmark asserted a competing German legitimacy, even as the two systems moved farther apart. A change in 1964 made that institutional distinction more explicit. From 1964 to 1974, the currency of the German Democratic Republic was called the Mark der Deutschen Notenbank. The new designation shifted attention away from the broad national claim contained in Deutsche Mark and toward the issuing institution. It identified the money with an East German monetary structure rather than leaving it open to confusion with the Western DM. The bank's name on the currency helped turn an administrative separation into a visible feature of ordinary transactions. In 1974, the designation changed again. From then until 1990, the official currency was the Mark der DDR, issued by the Staatsbank der DDR. The state itself now stood directly in the name. This wording was more than a convenient label. It expressed the German Democratic Republic's presentation of itself as a consolidated and distinct political entity. A currency that had initially retained a name shared with its Western counterpart had become one that explicitly announced East German statehood. The sequence from Deutsche Mark to Mark der Deutschen Notenbank to Mark der DDR traced a gradual movement from unresolved national competition toward formal separation. None of these changes altered the physical function of money. The mark remained the unit in which prices, salaries, savings, and public accounts were stated. Yet the revised inscriptions changed what that unit communicated. They placed first Germany, then the issuing bank, and finally the socialist state at the center of its identity. Such labels reach citizens in a particularly persistent form. Political language printed on money did not remain confined to speeches, treaties, or official ceremonies. It accompanied routine purchases and repeatedly associated value with a particular institution and territorial order. The Eastern mark thus served simultaneously as payment, as evidence of sovereignty, and as a compact statement about which Germany, its issuer, represented. By 1990, the Mark der DDR had completed a 16-year span under its final name, while the underlying Eastern currency had existed under 3 successive designations since 1948. Those names recorded the changing terms in which East German authority understood and displayed itself. Zatombe also prepared a broader symbolic contest conducted through denominations, inscriptions, emblems, and remembered traditions. How did the two German states use coins and currency names to make political allegiance and historical distance visible? The contrast was visible not only in the post-war marks, but in a longer succession of monetary images. A coin was a practical object, yet its small surface offered an issuer a durable means of identification. Names, coats of arms, eagles, portraits, dates, and legends condensed claims that might otherwise require a proclamation. Earlier series therefore provide a useful background to the symbolic competition between East and West. In the Weimar Republic between 1923 and 1933, Reichsmark coins were issued in denominations ranging from 1 to 5 Reichsmark. Their monetary name retained the word Reich, although the constitutional order represented by that term had changed. The pieces joined an inherited national vocabulary to republican rule, making continuity and rupture visible at the same time. Their designs could commemorate prominent figures, places, anniversaries, or public ideals, while the issuer's title identified the political framework within which those subjects were presented. The smaller denominations carried the same relationship between ordinary payment and official identity. Weimar coinage included Reichspfennig and Rentenpfennig pieces from 1 to 50 Pfennig. The coexistence of these names reflected the unsettled monetary conditions of the early Republican period and the effort to stabilize value after inflation. Yet for most users, such pieces were encountered less as constitutional documents than as change received at shops, ticket counters, or markets. That routine circulation was precisely what gave their words and emblems unusual reach. A monument might be visited occasionally. A coin could repeat the state's vocabulary several times in a single day. The National Socialist seizure of power in 1933 did not immediately require an entirely new ladder of denominations. Through the period ending in 1945, coins continued to include mark pieces from 1 to 5 mark and Reichspfennig pieces from 1 to 50 Pfennig. The apparent numerical continuity concealed a profound alteration in political meaning. Existing monetary terms could be retained while republican imagery gave way to the symbols and ideological language of the dictatorship. The coin's function remained mundane, but its appearance helped normalize the new regime's claim to embody nation and state. Continuity in denomination made the transformation easier to absorb. Familiar values now carried different signs of allegiance. Wartime issues extended this use of money beyond the Reich's ordinary domestic sphere. National Socialist-era coinage included Reichskredit-Kassenmünzen, produced for use in territories under military occupation, as well as occupation coins for the general government in German-occupied Poland. These issues were not merely substitutes created by shortages. They helped organize controlled economies and marked unequal political relationships. The authority determining what counted as money also influenced wages, prices, requisitions, and access to goods. On such coins, domination appeared in compressed form, a nominal value, an authorized design, and a territorial field in which the issue was intended to circulate. A different connection between territory and monetary identity can be seen in the Free City of Danzig. Coins were minted for this politically exceptional city-state from 1920 to 1939. Its separate issues made the jurisdiction's special position tangible. Danzig was neither simply a continuation of the pre-war order nor an ordinary part of neighboring Poland. Its coins supplied a visible sign of institutional separateness, even while trade and geography tied the city closely to surrounding monetary systems. Here, minting power did not necessarily indicate complete independence in every respect. It nevertheless distinguished a defined political space and communicated that distinction through everyday transactions. These examples clarify why post-war coin designs and currency names carried such weight. Monetary sovereignty had repeatedly been used to express republican legitimacy, dictatorship, occupation, and territorial exception. A change in emblem could announce a new regime without changing the denomination. A separate series could draw a political boundary without erecting a physical barrier at every transaction. Conversely, common or historically related terminology could preserve a sense of connection even where governing structures had diverged. The two post-war German money systems thus belonged to a tradition in which coins acted as political visiting cards. They identified the issuer, suggested a historical lineage, and defined the community within which value was guaranteed. Yet the eventual movement of those two systems toward one another raises a different historical question. Was the later convergence of the two German monetary areas unprecedented, or were there older models for currency unification across political borders? Older precedents can be found in the monetary arrangements that connected the German lands before political unity. They did not abolish regional governments, local identities, or separate traditions. Instead, they sought to make different systems intelligible to one another. The Dresden Coinage Treaty of 30th July 1838 offers a particularly clear example. Its purpose was to link the thaler areas with the guilder areas through an agreed relationship rather than force either side to abandon its familiar unit. Under the treaty, 1 thaler corresponded to 1.75 guilders. The relationship was expressed through smaller denominations as well. 30 Silbergroschen used in the thaler area were set equal to 105 kreuzes used in the guilder area. Such figures may appear technical, yet they addressed a practical difficulty encountered by merchants, travelers, tax officials, and money changers. A price written in one regional system could be calculated in the other according to a recognized rule. The agreement therefore reduced uncertainty without requiring every community to speak the same monetary language. The treaty also created a tangible symbol of cooperation. A new large silver coin, the Vereinsmünze, was assigned a value of 2 thalers or 3.5 guilders. Its importance lay not merely in its metal content or purchasing power. It represented a shared monetary reference that could circulate across the connected areas. Someone using the coin did not need to treat every border as the beginning of an entirely separate system. The piece made the exchange relationship visible in daily life, while its dual valuation acknowledged that the participating regions retained their established units. This arrangement illustrates a recurring method of economic integration. Governments could preserve their authority and local habits while standardizing the points at which those systems met. A treaty could define ratios, weights, and acceptable pieces even when no single political institution controlled the whole field. Integration consequently proceeded by agreement and comparison. It was less dramatic than creating one state, but it could be highly consequential for trade. The Vienna Coinage Treaty of 24th January 1857 extended this approach. It introduced the simple Vereinsthaler as official currency throughout all customs union countries, including the southern German guilder countries and Austria. The scope was broader than the earlier connection between two regional units. The Vereinsthaler offered a common monetary instrument across a large area whose members still differed in political structure and administrative practice. A merchant could therefore rely on a wider zone of recognition, even though the treaty did not erase every local denomination or establish a unified government. Vienna also standardized the basis on which precious metals were measured. The older weight mark, or Gewichtsmark, was replaced by the Zollpfund, defined as 500 grams. This change mattered because a monetary agreement required more than names and exchange ratios. It needed a dependable physical standard for the metal from which coins were made. If different authorities assessed silver according to different measures, confidence in the shared unit would remain fragile. The customs pound supplied a common point of reference that could be applied across the participating territories. The treaty specified that 1 pound of fine silver equaled 30 Vereinsthaler. This rule connected the coin directly to a defined quantity of precious metal. It did not make the Vereinsthaler a simple piece of bullion, since coins also depended on legal recognition, minting rules, and public confidence. Still, the measure imposed discipline on the system. The value of the common piece could be related to a known amount of fine silver rather than left entirely to local interpretation. These treaties show that monetary unity could grow through carefully chosen standards. The Dresden Agreement aligned thaler and guilder calculations. Vienna widened the circle and regularized the material foundation. Neither settlement eliminated regional difference. Their achievement was more modest and more durable. They made difference manageable. Shared measures and agreed conversions could bind markets together before political borders disappeared, creating habits of cooperation that later projects could inherit. Wie wird aus 2 deutschen Währungen 1990 wieder ein gemeinsamer Geldraum? Und warum endet dieser wenig später in einer noch größeren europäischen Währungsunion? The answer began in the South, where monetary cooperation developed without requiring political unification. In 1837, the southern German states that used the Gulden established the South German Monetary Coalition. Their purpose was practical. Merchants, officials, and mints needed a rule that would make the various Gulden issues comparable. The coalition therefore prescribed a 24.5 Gulden coin standard for minting Gulden. A specified number of gulden had to be struck from a defined quantity of silver so the unit could be connected to a material basis rather than determined anew by each mint. This arrangement did not erase the differences among the participating states. A coin could still carry the name and symbols of its issuing authority, and local habits of calculation remained important. Yet the agreement reduced uncertainty. Traders could estimate the metal content of a gulden more reliably, while governments gained a framework for settling payments with their neighbors. The monetary coalition was thus an early example of unity through technical coordination. Agreement began with the scale, the metal, and the arithmetic. The next step tried to bridge the larger divide between gulden lands and thaler lands. The Dresden Coinage Convention of 1838 defined a common coin for both groups. Its standard was expressed through the fine mark. 7 pieces were to be produced from 1 fine mark of silver. That formula gave the new piece a shared reference even though the surrounding accounting systems remained different. The convention did not demand that everyone abandon the terms they already used. Instead, it created a coin capable of being understood in both systems. This common Vereinsmünze embodied that compromise. Under the Graumann standard, it was a 2-thaler piece, known as a Doppelthaler. In the Gulden system, the same coin counted as 3½ Gulden. Its significance lay precisely in this double identity. One object could satisfy 2 established ways of reckoning, allowing payments to cross monetary boundaries without requiring every participant to learn a completely new unit. The Doppelthaler was not a final solution to every difficulty. It was a bridge, and bridges are valuable because the shores remain distinct. Such arrangements reveal a recurring pattern in German monetary history. Monetary integration often advanced before political integration, and it advanced by making conversions predictable. A common standard could encourage commerce even when separate administrations retained authority over taxation, banking, and minting. Trust did not arise from sameness alone. It grew when people could test the relationship between units, recognize the quality of the metal, and rely on institutions to preserve the agreed ratio. The national mark later supplied a more powerful symbol of unity, but it also tied money more closely to a single state. After the Second World War, the division of Germany produced separate political and economic systems. In the German Democratic Republic, shortages, weak productivity, and structural difficulties undermined the credibility of the existing monetary order. By the end of the 1980s, the contrast with the prosperous Western system had become impossible to ignore. Money was not merely a medium for purchases, it had become a visible measure of political performance. In 1990, the response was rapid and extraordinary. The economic weakness of the DDR was followed by a German-German monetary union. The D-Mark became the common money before the 2 German states achieved formal political unity. For many people, this sequence made the currency a promise of stability and belonging. Wages, savings, prices, and contracts were converted according to rules that sought to combine social reassurance with economic discipline. The decision also reflected political pressure. A shared currency could make separation appear temporary and unity tangible in daily life. Yet the transition carried costs. Exchange rates could not make 2 economies equally productive overnight. Enterprises in the East faced competition under conditions they had not chosen, while public finances absorbed the burden of adjustment. The D-Mark offered confidence, but confidence in a currency could not by itself repair factories, infrastructure, or employment. Once again, monetary unity made differences manageable without making them disappear. Only a few years later, Germany accepted an even wider transformation. European Monetary Union placed the national currency within a supranational framework. The euro entered use in 1999 as book money, governing accounts, transfers, and financial calculations. In 2002, euro banknotes and coins followed, bringing the new unit into ordinary transactions. Germany thereby surrendered the D-Mark, a currency associated with post-war recovery and institutional trust, in exchange for participation in a larger monetary space. The path from the Gulden coalition to the euro therefore moved through three scales. Regional agreements first aligned standards across neighboring territories. The national mark then gave monetary unity a statewide form. European integration finally separated a common currency from any single national government. Each stage required rules, institutions, and confidence that obligations would remain credible. The underlying question never disappeared. Who stands behind the money, and why should people trust it? Kann eine gemeinsame europäische Währung auf Dauer ebenso viel Vertrauen stiften wie die D-Mark, obwohl hinter ihr kein einzelner Nationalstaat steht? The euro makes that question easier to pose because its physical form reveals how far money has moved from the value of its substance. A euro coin is accepted for the amount stated on it, not for the market price of the metals it contains. Its purchasing power rests on agreed rules, legal recognition, and the expectation that others will accept it in turn. This directs attention back to a basic question in monetary history. When did the material itself determine value, and when did the stamped denomination become decisive? For much of earlier history, the two remained closely connected. Within the Holy Roman Empire, from the Middle Ages into the modern era, only gold, silver, and copper were permitted in coin alloys. These metals formed a recognized hierarchy. Gold and silver carried substantial intrinsic value, while copper served smaller payments and subsidiary units. Restrictions on permissible materials were therefore not merely technical. They protected assumptions about what a coin was supposed to be, a measured quantity of an accepted metal, certified by an issuing power. The stamp mattered, yet it referred to something that could also be weighed, tested, melted, or traded. That relationship became almost unrecognizable during the inflation of 1923. The only coin types minted that year to mark the inflationary period were pieces worth 200 and 500 mark, both made of aluminium. Their high figures contrasted sharply with their light, inexpensive substance. They were not stores of metallic wealth. They were counters whose nominal values were already being overtaken by the rise in prices. Aluminium suited this situation precisely because little valuable material could be risked in an object whose stated purchasing power might collapse before it had circulated for long. The distance between inscription and substance grew still larger in the state emergency money of the province of Westphalia. Its Notmünzen, produced within the period from 1923 to 1933, reached a denomination of 1 trillion mark, the largest nominal value ever placed on a coin. The object did not contain anything remotely equivalent to that sum. Indeed, the immense number recorded not wealth, but the destruction of the unit used to measure wealth. A trillion had become suitable for a single token because the mark itself had lost nearly all practical scale. The denomination was grotesque, but it followed the logic of inflation. As the unit shrank, the printed or stamped number had to expand. Such pieces also expose the limits of the term face value. A number on metal does not create purchasing power by itself. It works only while laws, public institutions, sellers, and buyers continue to treat that number as meaningful. In 1923, official authorization could establish what a piece was called, but it could not ensure what the amount would buy tomorrow. State acceptance remained necessary, yet it was no longer sufficient to stabilize value. Confidence required an expectation of continuity, and inflation dissolved that expectation from one transaction to the next. More stable money does not entirely escape the influence of its material. In 1975, West Germany withdrew the 5-mark silver coin known as the Silberadler and replaced it with a Magnamat version because silver prices had risen. The old piece risked becoming worth more as metal than as money. Once that threshold approached, people had an incentive to hoard or melt it rather than spend it at its stated value. Magnamat, a less costly layered material, restored the intended relationship. The 5-mark piece could circulate according to its denomination without its metallic content competing with that denomination. The aluminium pieces of 1923 and the Magnamat replacement of 1975 arose under radically different monetary conditions, but they illuminate the same separation. Material gives a coin durability and makes it physically recognizable. The denomination assigns its place within a monetary system. Public authority declares the terms under which it will be accepted, while collective confidence allows those terms to govern ordinary exchange. When these elements support one another, the metal can recede into the background. When they diverge, the coin may be hoarded for its substance or rejected despite the number on its face. The history of money is therefore not a simple progression from precious metal to valueless token. It is a repeated renegotiation between substance, nominal value, and credible acceptance. Yet this raises an older question. How could the mark, long before modern coins, function purely as a unit of account without ever being struck at all? It could do so because calculation did not require a corresponding object. A monetary name might describe a quantity to be weighed, a sum to be entered in a ledger, or a relationship among smaller denominations. Coins used to settle that sum could vary in age, origin, and metallic quality. Provided that merchants, officials, and debtors understood the reckoning, the named quantity remained usable even when no piece of metal bore its name. The mark began in precisely this unsettled space between weight and money. It was often less a coin than a measure, a way of grouping value into a recognized whole. Its early usefulness lay not in the promise that one particular disc could be produced, but in the possibility of translating diverse payments into a shared numerical order. A person could owe 1 mark without possessing or even expecting to see a mark coin. Settlement might instead require an agreed number of smaller pieces, or an amount of metal judged equivalent to the stated obligation. The Danish mark shows how closely weight concepts and monetary arithmetic could be joined. It was divided into 16 shilling, with each shilling containing 12 pfennig. 1 mark, therefore, comprised 192 pfennig in the system of reckoning. The hierarchy made large and small sums mutually intelligible. Pfennig could be counted into shilling, and shilling into a mark. At the same time, the name retained the memory of measured substance. The resulting structure was neither simply a weight standard nor merely a list of coin denominations. It was a bridge between the expectation that value could be measured materially and the practical need to organize it numerically. Such systems were especially helpful where the available coins did not form a neat, uniform series. A ledger could preserve stable proportions even when actual payment involved assorted pieces. This did not make physical money irrelevant. Someone still had to decide which coins would discharge the debt and at what rate. Yet the accounting framework gave the transaction a fixed language before the particular means of settlement had been chosen. The abstract sum could be clear even when the contents of the purse were not. Under Alfred the Great, the mark was introduced into England and Scotland. There, its abstraction became particularly evident. The English and Scottish mark served only as currency of account. No mark coins were ever minted. Nevertheless, its value was exact and widely expressible. 1 mark equaled 2/3 of a pound sterling, or 13 shillings and 4 pence. Since the pound contained 20 shillings and each shilling 12 pence, the equivalents followed directly. 13 shillings made 156 pence, and another 4 brought the total to 160, exactly 2/3 of the pound's 240 pence. Thus, the mark existed there as a ratio. It could appear in contracts, valuations, rents, fines, or calculations without appearing in anyone's hand. A debt of 1 mark was not a request for a missing coin. It was an instruction to pay the equivalent through denominations that did exist. The absence of a mark piece was therefore not a defect in the system. On the contrary, it reveals how completely monetary thought could separate a named value from a single physical form. Nor was this confined to Northern Europe. The Berner mark was used as a reference value in northern Italy and Tyrol from the 10th century until 1551. Its long life across these regions is notable because more than 5 centuries allowed ample time for rulers, mints, trade routes, and the metallic composition of circulating money to change. Yet the named standard could continue to provide a point of comparison. What endured was not necessarily an unchanged piece of silver, still less a continuously minted coin, but a conventional frame in which obligations and values could be stated. This endurance depended on memory, reinforced by repeated use. Once a monetary name entered records and customary calculations, replacing it imposed costs. Old agreements had to be interpreted, prices translated, and familiar proportions relearned. A term could consequently outlast the material basis that had first made it meaningful. The mark might begin with weighing, become a counting relationship, and later attach itself to entirely different monetary arrangements. Its continuity was verbal and institutional rather than metallic. That continuity also complicates any search for a single origin of monetary value. The mark could be real without being tangible, exact without being minted, and durable without retaining one permanent material definition. Yet why did the name mark in particular survive in such different countries even after its concrete basis of value had long since changed? The answer lies partly in the name's flexibility. Mark no longer needed to denote a particular weight, metal content, or coin. It had become a compact monetary signal, a term that could suggest order, calculability, and a degree of political autonomy without binding its users to one inherited material standard. Governments could therefore adopt it while constructing arrangements that differed sharply from those of earlier centuries. Finland offers the clearest example of this movement beyond a narrowly German setting. The Finnish mark was used from 1864 to 2001. Its introduction occurred while Finland remained a grand duchy within the Russian Empire, so the new money did not initially express full national sovereignty. It did, however, give Finland a distinct monetary identity and greater room to organize its own economic affairs. In this setting, the name was useful precisely because it was recognizable without being tied to a single foreign polity. It could furnish a new framework with the appearance of historical familiarity. The Finnish case also shows how long such a transferred name could endure. Political circumstances changed repeatedly between 1864 and 2001. Finland became independent, experienced war and reconstruction, and developed into a modern Nordic state. Through these transformations, the Finnish mark remained. Only the move to the euro ended its use. By then, the term had accompanied Finnish monetary life for well over a century, acquiring associations that were specifically Finnish rather than borrowed or derivative. Whatever linguistic and historical connections the name retained, its public meaning came from Finnish institutions and experience. The dissolution of empires after the First World War created further opportunities for the term to be reused. Newly established states needed money that could make political separation visible while also supporting taxation, public expenditure, contracts, and ordinary exchange. A familiar monetary word could assist this process. It offered continuity of vocabulary at a moment when borders and institutions were being remade. Estonia used the Estonian mark from 1918 to 1927. The dates closely frame an early phase of Estonian statehood, when independence had to be translated into functioning administrative and financial structures. The Estonian mark was consequently more than a label for payment. It belonged to the practical work of creating a separate public order after imperial collapse. Its relatively brief life does not make it insignificant. Transitional money may be short-lived because it succeeds in carrying a state from institutional improvisation toward a more settled system. In 1928, the kroon took its place, but the mark had already served during the formative years. Poland followed a comparable chronology without reproducing the same institutional path. The Polish mark was used from 1918 to 1926. Re-established Poland brought together territories that had previously belonged to different empires and had lived under differing fiscal and monetary practices. A common named medium helped express the ambition to make those regions part of one state. Yet the Polish mark also became associated with the severe instability of the early post-war years. Its replacement by the zloty marked an attempt to secure a firmer basis for public finance and exchange. Here again, the mark functioned as a transitional language of sovereignty, important in the founding moment, but not destined to become permanent. These examples reveal that adoption did not guarantee longevity. Finland retained the name until 2001, whereas Estonia and Poland abandoned it within a decade. The contrast matters. A monetary name did not dictate the strength of the institutions behind it, nor did it determine whether stabilization would succeed. It supplied a recognizable form into which very different political projects could be placed. The term's later history in Bosnia and Herzegovina makes that separation still clearer. The convertible mark has been used there since 1998. It emerged from the post-war reconstruction of a state whose internal organization and monetary needs bore little resemblance to those of medieval weighing practices, 19th century Finland, or the newly independent states of 1918. Its defining idea was convertibility under a tightly regulated institutional arrangement. The name initially recalled the Deutschmark, to which it was linked. After the latter disappeared, the fixed relationship continued through the euro. Thus, mark survived even when the external money that had supplied the immediate reference was gone. The convertible mark is not evidence that one continuous German monetary system spread intact across the continent. Rather, it demonstrates how completely a word can detach itself from its earliest setting. In Finland, Estonia, Poland, and Bosnia and Herzegovina, the name entered distinct languages of state-building, independence, transition, or post-war reconstruction. Its history had become European, connected by vocabulary, yet divided by chronology, purpose, and institutional design. But what variety lay hidden beneath such large reckoning standards in the everyday small change of the Middle Ages? That question leads away from large reckoning standards and toward the small pieces that actually circulated in markets, workshops, inns, and village dues. The names Heller, Scherf, albus, and witan belonged to a world in which a pfennig was rarely an entirely uniform object. Its value depended on metal content, local authority, customary exchange, and the practical needs of payment. The older background was the gradual disintegration of the Carolingian royal coinage prerogative. From the 12th century onward, the right to strike money increasingly fragmented among regional powers. The result was not simply a greater number of mints. Regional pfennigs began to differ more sharply in weight, fineness, and public acceptance. A pfennig from one territory might not command the same value as a similarly named piece elsewhere. What looked like a single denomination was therefore a family of local currencies whose relationships had to be learned through use. The sheriff represented the most direct form of division. It was a half pfennig, and the name could describe an actual physical act. A pfennig might be cut into two parts so that each half could serve for a smaller payment. Such cutting was not merely symbolic. It showed how monetary practice adjusted itself when the available coin was too large for the price being paid. Fractions could be produced at the point of exchange without waiting for a mint to supply a separate small denomination. The resulting pieces were irregular, but their purpose was clear. The heller followed a different path. The early Swabian heller was a full pfennig, not a fraction. Only from 1385 did it become a half pfennig. That change illustrates how a monetary name could retain its identity while its effective value shifted. The alteration was not necessarily obvious from the word itself. Users had to know the local rule, recognize the relevant issue, and understand how the piece stood in relation to other small coins. A name could be stable, while the monetary system around it was not. The albus introduced another regional tradition. From the middle of the 13th century, Trier and Cologne produced a silver-containing dinar or pfennig known as the albus. Its name, associated with whiteness, emphasized appearance as well as substance. Compared with darker or more heavily coppered small change, a silver-bearing coin could advertise a distinction that was visible in the hand. Yet appearance did not settle value by itself. Weight, fineness, minting authority, and the reputation of the issuing place all shaped what the albus could purchase beyond its immediate locality. In northern Germany, a more coordinated answer emerged through the Wendish Coinage Association. Beginning in the early 14th century, this association promoted the witan, a 4-pfennig coin. The piece was whitened by boiling, a treatment that brightened its surface and gave it a recognizable appearance. Here, the important feature was not only the coin's metal, but also the agreement supporting its circulation across a trading region. A witan could function more effectively because several participating towns gave the type a shared basis. Commercial connections encouraged monetary coordination where broader political uniformity was absent. These examples reveal everyday money as a map of authority. The distribution of the heller pointed towards Swabian practice and later monetary revision. The sheriff reflected the practical division of a larger piece. The albus marked the influence of Trier and Cologne, while the witan expressed cooperation among northern trading towns. Each coin carried a history of jurisdiction, technology, commerce, and local expectation. Small change, therefore, did not form a single ladder descending neatly from larger standards. It was a patchwork of regional solutions. Some fractions were made by cutting, others were defined by decree. Some pieces relied on silver content, others on surface treatment, and still others on agreements that made them acceptable across several towns. Their relations could alter without their names disappearing, and their circulation could extend beyond the place where they were first produced. For the person buying bread, paying a toll, or settling a minor obligation, this diversity was practical knowledge. The question was never merely how many pieces were present. It was which pfennig, which half, which local convention, and which regional relationship applied. Behind the smallest payment stood the unresolved issue of how separate monetary authorities might be brought into a common order. Wie versuchte das Reich, diese zersplitterte Münzwelt durch verbindliche Relationen zwischen Gold, Silber und Kreuzer zu ordnen? The imperial answer took the form of prescribed relations among recognized coins. Rather than removing regional money at once, the authorities attempted to place important gold and silver pieces within a common scale expressed in kreuzers. The first Augsburg Mint Ordinance of 1551 still sought to preserve the idea that a gold gulden and a silver gulden were equivalent. It assigned each of them a value of 72 kreuzers. On paper, the shared figure allowed obligations stated in gulden to retain a seemingly stable meaning regardless of which metal supplied the actual payment. Yet the same ordinance valued the thaler at only 68 kreuzers. This difference exposed the difficulty concealed by the equal valuation of the two gulden types. A gold gulden, a silver gulden, and a thaler were not simply interchangeable embodiments of one monetary quantity. They belonged to different minting traditions, contained different metals, and responded differently to supply, demand, and circulation. Declaring the two gulden forms equal did not make their market position equal, while the lower rate assigned to the thaler introduced a further relation that users had to remember. The ordinance organized the discrepancy without eliminating it. 8 years later, the Reichstag at Augsburg returned to the issue. In 1559, Ferdinand I presented the Third Reichsmünzordnung, issued under the title Kaisers Ferdinandi nur Münzordnung zu Augsburg, M.D. Nr. 9. Its provisions abandoned the nominal parity between gold and silver guldens that the Ordinance of 1551 had attempted to maintain. The change was significant because it admitted openly that coins bearing the same gulden designation could not necessarily retain one fixed value when they were made from different metals. The gold gulden nevertheless survived. At the request of the Electoral Palatinate, the ordinance retained it and set its value at 75 kreuzers. The silver gulden, by contrast, was valued at 60 kreuzers. What had been a declared relation of 72 to 72, the revision did not merely alter two numbers. It separated the monetary rolls previously gathered beneath a common name and placed the gold piece above the silver one within the kreutzer scale. The same measure also introduced the ducat as a new gold coin. Augsburg therefore did not produce one exclusive imperial piece to displace all rivals. Gold payments could involve the retained gold gulden or the newly recognized ducat, while silver payments continued to involve the silver gulden and the thaler tradition. The reform created a more explicit hierarchy, but its order remained plural. Several coins could be legitimate at the same time, provided that their prescribed values, weights, and relations were known. This plural structure reflected the limits within which imperial monetary legislation operated. Coin names were already embedded in taxation, contracts, tolls, savings, and regional habits. A sudden abolition could disrupt established obligations as readily as it could simplify them. The Augsburg settlement instead tried to discipline existing practice by stating which pieces should remain and how they should be compared. Its achievement lay less in monetary unification than in making distinctions official. The Ordinance of 1559 also established the basis for the Reichsthaler that followed in 1566. In that year, the Reichsthaler was defined according to a 9-thaler standard, the 9-thaler Fuß. 9 Reichsthalers were to be struck from 1 Cologne mark of fine silver. This rule connected the coin to a specified quantity of precious metal and gave imperial legislation a clearer standard for judging production. The Kreutzer valuation addressed the relation among denominations, while the minting foot governed how much fine silver should underlie the larger silver coin. A carefully stated standard, however, still depended on mints observing it and markets accepting its official consequences. Gold and silver could change in relative value. Older and foreign pieces remained in circulation. Territorial rulers and cities retained interests in their own issues, and users could distinguish between a coin's legal rate and the rate obtainable in payment or exchange. Augsburg supplied a framework within which these tensions could be managed, but the multiplication of clauses also revealed how many forces lay beyond a single decree. Warum konnte selbst eine detaillierte Reichsordnung das Problem schwankender Kurse und konkurrierender Münzherren nicht endgültig lösen? Geld für Übergangsräume. The difficulty lay in the distance between a rule and the institutions capable of enforcing it. That distance did not disappear with the modern state. In the 20th century, territorial monetary distinctions returned under the exceptional conditions of war, occupation, and political transition. The new issues were not survivals of an older constitutional fragmentation. They marked spaces whose sovereignty, administration, or future affiliation remained unsettled. One early example arose in Oberost, the vast eastern territory administered by Germany during the First World War. German occupation coins were minted for Oberost between 1915 and 1918. Their existence made the occupation materially present in ordinary transactions. A military administration needed payments to function, wages to be made, and small purchases to be priced. Supplying distinctive money helped separate the occupied territory from surrounding monetary systems, while tying its economic life to the occupying administration. The coins thus belonged to a temporary order, but temporary did not mean inconsequential. They entered shops, pay packets, and household reserves, giving a provisional territorial arrangement a tangible form. A similar pattern appeared after the Second World War on a much larger scale. Coins were minted for the Allied occupation period from 1945 to 1948. These pieces occupied the interval between the destruction of the previous political order and the establishment of successor monetary regimes. Their designs and inscriptions avoided resolving questions that had not yet been settled. Nevertheless, commerce could not wait for a final constitutional outcome. Small change was required even where public power was divided and the eventual boundaries of currency areas remained uncertain. The monetary transition in Western Germany in 1948 involved more than distributing new notes and coins. It also required a legal inventory of claims inherited from the former system. Natural and legal persons had to surrender old cash and register their balances by June 26, 1948. The deadline transformed a broad political rupture into a specific administrative act. Households, firms, associations, and other entities had to disclose what they held and submit those holdings to the conversion rules. Money that was not presented or registered in the prescribed manner risked losing recognition within the new framework. Such procedures show that a currency reform sorts owners and claims, as well as pieces of paper. Cash could be physically delivered, but bank deposits, contractual sums, and savings balances had to be identified in records. Officials needed to determine which claims existed, who possessed them, and how they should be treated. The change, therefore, depended on forms, registers, financial institutions, deadlines, and categories of eligibility. A new monetary order emerged through accounting and adjudication, no less than through replacement currency. The consequences were not exhausted in 1948. Savers could view the reduction of old balances not merely as a technical conversion, but as the destruction of accumulated security. Political demands for compensation continued after the immediate reform had ended. In 1953, the Altsparergesetz addressed part of this legacy. It upgraded qualifying savings accounts that had already existed on January 1, 1940, to 20% of their Reichsmark nominal value. The qualifying date distinguished older savings from balances accumulated during the war and its inflationary aftermath. The percentage did not restore the full nominal sum, yet it granted selected claims a higher value than the original conversion had allowed. This legislation demonstrated the long afterlife of a monetary break. 5 years after the Western Reform, lawmakers were still deciding how losses from the superseded system should be distributed. The past had not vanished when its cash was withdrawn. It survived as evidence in account books, as expectations among savers, and as disputes over whether formally valid balances represented legitimate long-term accumulation. Monetary succession remained a question of justice as well as calculation. The Saarland formed another conspicuous transitional space. Between 1947 and 1959, it possessed its own coinage, making its exceptional political and economic position visible in money. Located between post-war Germany and France, the territory followed a separate course before its eventual incorporation into the West German monetary area. Its coins did not simply facilitate minor payments. They signaled that the Saarland was being administered and economically oriented under arrangements different from those applying nearby. Ober-Ost, the post-war occupation issues, the Saarland, the registration deadline of 1948, and the later revaluation of older savings all revealed different dimensions of provisional money. Some measures supplied a bounded territory with circulating pieces. Others classified inherited claims or revised the treatment of losses years later. In each case, transition required someone to determine not only what people could spend, but what records, balances, and prior rights would continue to count. Welche Institutionen entscheiden in solchen Übergängen darüber, welches Geld bilanziell, rechtlich und im täglichen Handel tatsächlich gilt? The answer lay not in a single office, but in a network of institutions empowered to issue money, define obligations, supervise circulation, and translate political decisions into prices and balance sheets. A monetary order became effective only when its rules were administered consistently. Notes and pieces might display sovereignty, yet their practical value depended on organizations capable of maintaining the framework within which payments, contracts, and commercial records were recognized. A decisive step toward such a framework came with the Reichsbank. Founded on January 1, 1876, as the successor to the Prussian Bank, it provided the recently unified Reich with a central monetary institution. Political unification and currency consolidation thus acquired an organizational foundation. The significance of the Reichsbank extended beyond the production or circulation of notes. It stood at the center of a system in which monetary authority increasingly belonged to the national state rather than to a collection of regional issuers. Uniformity required an institution able to make common rules operative across territorial boundaries. That process of concentration remained incomplete for decades. Private central banks continued to exist alongside the Reichsbank, preserving remnants of an older, more dispersed structure. In 1935, all private central banks in Germany were abolished. Their elimination completed a further stage of centralization, placing monetary authority more exclusively within a state-directed hierarchy. Centralization, however, did not guarantee sound money. An institution could coordinate policy and enforce decisions while still being subjected to political objectives that undermined monetary restraint. Organizational unity and stability were related, but they were never identical. The institutional reconstruction of the Western monetary system began before the new notes reached the population. On March 1, 1948, the Bank Deutscher Länder was founded in Frankfurt am Main. Its creation supplied an authority through which monetary decisions in the Western zones could be prepared and implemented. The sequence mattered. An issuer and coordinating body had to exist before a currency could function as more than newly printed paper. The monetary break, therefore, began administratively, inside offices and banking structures, before it became visible in wallets, shop tills, and wage packets. The reform also altered the conditions under which money could be used. Ludwig Erhard coupled the currency change with the abolition of price binding and rationing regulations in 1948. New money and a new market order consequently became perceptible at nearly the same moment. Prices were again expected to convey information about scarcity and demand, rather than merely reproduce official schedules. The easing of rationing rules shifted transactions away from permits, allocations, and regulated distribution. Monetary reform was thus inseparable from a decision about how economic coordination should occur. This simultaneity carried political risk. Replacing the means of payment without changing the regulated economy might have left goods unavailable at official prices. Removing controls without establishing credible money might have produced disorder rather than exchange. The combined measures sought to restore a relationship among purchasing power, visible supply, and freely formed prices. Their effects were experienced in ordinary commerce, but the underlying transformation depended on coordinated legal and institutional action. Commercial bookkeeping required its own formal rupture. The Bilanzgesetz of August 21, 1949, obliged companies to prepare an opening balance sheet in D-Mark. Businesses could not simply continue their old books while changing the symbols attached to the figures. Assets, liabilities, capital positions, and prior claims had to be restated within the new monetary framework. The opening balance sheet marked a boundary between inherited nominal values and the valuations accepted under the reconstituted order. This requirement shows why currency reform reaches far beyond cash. A note can be exchanged rapidly. A firm's financial history cannot. Factories, inventories, debts, receivables, and equity remain, but their recorded relationships must be reconsidered when the monetary scale changes. By compelling companies to establish a new starting point, the law carried the reform into ledgers and made the institutional break part of economic memory. Monetary stability therefore appears not as an intrinsic quality of paper or metal, but as an outcome produced by banks, legal rules, price formation, and credible balances. Issuing institutions organize circulation. Governments establish the permissible framework. Markets test whether prices can coordinate exchange. Bookkeeping rules determine which claims survive in recognized form. None of these elements alone is sufficient. Together, they make money usable not only for immediate payment, but also for calculation across time. What happens when such institutional safeguards fail and monetary value collapses faster than state and society can react? Hush Hush, der Zusammenbruch des Geldwerts. The failure came not as a single break, but as a sequence of accelerating losses. By January 1920, the mark's exchange value against the US dollar had fallen to 1/10 of its August 1914 level. This was already a profound reduction in purchasing power and international standing, yet it did not establish a new floor. By October 1921, the mark was worth only 1/100th of its pre-war value. By October 1922, it had fallen to 1,000th. Each interval was shorter, and each decline made the next more difficult to arrest. Inflation altered economic behavior long before the final catastrophe. Wages that appeared adequate when agreed upon could be insufficient when paid. Sellers shortened the periods for which prices remained valid. Those receiving money sought to spend it rapidly, because delay imposed an almost certain loss. Saving in nominal claims became perilous, while ownership of goods, foreign currency, or real property offered greater protection. The expectation of depreciation thereby contributed to further depreciation. Fewer people wished to hold money, and its circulation accelerated. The state faced expenses that could not easily be reduced and obligations that could not be met from ordinary revenue. Political conflict narrowed the range of credible choices. Reparations intensified the pressure, while attempts to bridge fiscal deficits through additional issues of paper money weakened the exchange rate further. The monetary crisis was therefore also a crisis of public authority. Prices conveyed not merely scarcity, but an increasingly widespread judgment that official promises could not preserve value over time. On January 11, 1923, the intervention struck at a major industrial region and transformed financial weakness into an open confrontation over sovereignty and compliance. Reichskanzler Wilhelm Kuno's government answered by calling for a general strike, known as the Ruhrkampf, and urging passive resistance. Workers and officials were expected not to cooperate with the occupying forces. Supporting that resistance carried immense fiscal costs. The government compensated strikers and assisted affected firms and communities, while production and tax receipts suffered. Rather than forcing a favorable settlement, the policy deepened the imbalance between state expenditure and available revenue. More paper money entered an economy producing fewer usable goods. Monetary depreciation, fiscal incapacity, and political defiance reinforced one another. Kuno's position became untenable. Gustav Stresemann succeeded him as Reichskanzler and, on September 26, 1923, terminated passive resistance in the Ruhr. Ending the Ruhrkampf removed one source of expenditure and opened the possibility of negotiation, but it could not immediately reverse the accumulated collapse. Confidence had already been destroyed. Contracts had been emptied of their expected meaning, and the price scale was changing too quickly for ordinary calculation. In November 1923, $1 cost 4.2 trillion marks. The figure expressed more than an extreme exchange rate. It measured the near disappearance of money's capacity to connect present work with future consumption. Notes with enormous denominations could settle transactions only briefly. Creditors saw claims evaporate, while some debtors could repay old nominal obligations with sums of negligible real worth. The effects were uneven, sharpening resentment between social groups and leaving memories that survive the discarded notes themselves. A stabilization required a recognizable limit. On November 15, 1923, the Rentenmark was introduced. It was backed by mortgages on agricultural and industrial landed property, giving the new issue a defined foundation at a moment when conventional reserves were inadequate. The backing was partly a legal and political construction, yet that did not make it irrelevant. Its purpose was to bind issuance to a limited base and persuade the public that the authorities would no longer respond to every demand by multiplying notes. The Rentenmark succeeded because restriction, fiscal change, and a readiness to accept the new measure converged. No physical transformation of farmland or industrial sites occurred when the notes appeared. What changed was the framework of expectations. People became willing to quote prices, receive wages, and retain balances in a medium whose future supply seemed more disciplined than that of its predecessor. The emergency arrangement was subsequently placed on a more durable footing. On August 30th, 1924, the Reichsmark was introduced at a 1-to-1 exchange rate with the Rentenmark. The equal conversion preserved the stabilized scale rather than imposing another abrupt recalculation. A provisional response to collapse thus became the basis of a more lasting monetary order. The episode showed that trust can be created anew even after devastating failure, but not through naming or symbolism alone. It depends on credible limits, political capacity, enforceable rules, and a public memory that shapes how later promises are judged. What lessons from inflation, reform, and institutional renewal continue to shape the German commitment to monetary stability and the future of the euro?